public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
We have an economy that's really strong. It's not normal to have rates at these low levels.
What the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
Given the rise of inflation, the hawks are more willing to show their hands.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferrell, and Lisa Abramowicz.
Don't call it a comeback from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance. Alongside Tom Keene and Lisa Abramowicz, I'm Jonathan Ferrell. Your equity price action is Tuesday morning. We're down about 0.1% on the S&P 500 TK. Chairman Powell up a little bit later this afternoon.
Yeah, Chairman Powell, some important comments. He'll be looking at Dow futures negative 34, 33,727 on the Dow, John. And John, to me, the number one statistic out there, which goes to Francisco Blanch later in the show, is we get a 75 print on Brent crude.
And Mr. Blanch of Bank of America throwing around a triple-digit number, Tom, 100. He's got to back that up a little bit later.
It's a well-written note. He makes no bones about it. We're going to go to 100 on demand. I love his phrase, work from car. But then we come back. You know, I think the time continuum here is so important. Whether it's transitory Powell or transitory Francisco Blanch, there's an ebb here. The media gets into a panic about a given trend. Blanch says up to 100, down to 65.
You throw shade at the media, Tom. Let's talk about the market participants
throwing
as well
shade at you,
in the last couple of weeks. Can you believe that people are prepared to shift their outlook on a subtle shift over at the Federal Reserve?
Well,
are we really talking about a year out based on last week's price action?
It's a lot. You got a lot in there, John. And the answer is yes, there's been an overreaction, but there it is, and we adjust. And I would suggest without yesterday's adjustment up in equities, you're right. It was not good. But, you know, it's ebbed and flowed over 2 or 3 days to maybe, not stasis, we're not there yet, but we're getting there.
Big adjustment in the bond market as well, Lisa. Your 10-year, 147.68.
Yeah, and perhaps it was an overreaction. Perhaps it was just a really good excuse for people to get out of certain positions, reset as they head into the second half of the year. To your point, though, I think that this is the key issue, the fact that there is more dispersion among the Fed members, but it doesn't necessarily mean the leadership's on board with a more hawkish tilt. In fact, they are doubling down on some of their more dovish rhetoric, John.
I'll catch up with President Williams a little bit later with Mike McKee. We'll do that at 9:30 Eastern. Got to remember how to do this on the S&P. Where are we? 4,200, exactly where we were 3 weeks ago when I left the building. Almost 4,200 on the S&P. Futures down about 0.1%. In the bond market, yields 147.68. Come and get a couple of basis points this morning. Ahead of Chairman Powell later.
Nothing's happened since you were gone.
And in foreign exchange, euro dollar 118.86. Lisa, stronger dollar through G10 this morning.
Okay, now the markets can actually get started. You're back, so we can actually see some direction, maybe. Today, we do have the New York City Democratic mayoral primary election. This really is basically the election, since the Democratic candidate usually does win. The key aspects here, number one, are that this is a ranked choice election. So when all the people are petitioning you on the street corners, they say, if you don't vote for our candidate for number one, vote for him for number two. And that's what you see. How will this work out to try to get a candidate that perhaps appeals to a broader swath of potential voters? Also facing New York City, the biggest city in the United States. How do you recover from a pandemic that's absolutely decimated the workplace culture as well as the population? 1 p.m., the U.S. is planning to sell $60 billion of 2-year notes. Tom Keene loves bond auctions, so I am going to go into detail. God. The reason why I care about this is because of the huge move that we saw upward in these yields in particular. You could see how it just climbed, surged up to the highest level since March on those more hawkish comments by a select few regional Fed presidents. How much will this turn into something that perhaps is a bit messier? 2 p.m., the Fed Chair Jay Powell will be testifying to a House subcommittee. The question that I have is, how much will he double down on a dovish tilt to emphasize that he and the likes of New York Fed President John Williams actually very much see this as transitory drink? There's the whole idea that they do expect inflation to come back down, as reiterated, frankly, in inflation expectations and break-even rates. And John, this to me is the question, this partition between the leadership of the Federal Reserve and the marginal marginal players that perhaps don't even have voting rights that are going to try to throw some caution into markets.
John,
I think Tom's got something to say,
I look at the
Lisa.
angst out there, John.
I think so.
I look at the market angst over 3 weeks.
You know, and he interrupts and then starts talking anyway.
Yeah,
sort of like what we're doing.
Look at the S&P drawdown. The drawdown is horrendous, 0.70%. I mean, equities have just really come back. They've corrected.
Tom, there's a big difference between having a more balanced outlook on the economy and shift and reaction function. And I think the problem that the Federal Reserve has right now is when they start to do the former just a little bit, people start to question the latter. Isn't that what's happened in the last week?
I think we're making it up as we go, and I think this Fed comments here. You saw the separation from John Williams yesterday with Kaplan and the others. I mean, there's some really fresh debate out of the Fed as they stagger to the next meeting.
Let's bring in Julia Coronado, shall we? Macro Policy Perspectives President and Founder. Julia, great to catch up. The Chairman of the Federal Reserve in front of a House committee today. How important is that forum, just in terms of what we might hear from Chair Powell?
Well, I think it's important to keep in mind that this is not an official FOMC hearing, so this isn't the semi-annual testimony. So Chair Powell isn't speaking for the entire committee. He's speaking more for himself and for the leadership that you were just referring to. So I do think that we'll hear a very flexible tone from Chair Powell. I don't think he wants to walk back the message of the June FOMC meeting. I do think that there is greater concerns about inflation, and they want to confirm that they're willing to act if it doesn't prove transitory. At the same time, Chair Powell at his core is a labor market dove, and he repeated over and over again, even in the press conference when he was speaking for the committee, that the key lesson on the labor market is how flexible it can be, how flexible labor supply can be. And we really need to give the economy the months of reopening, several more months of reopening, before we can read the tea leaves, and he believes the labor market will come back strong.
Julia, to John's comments there on where the market is versus where the Fed is, I mean, right now, and this goes to British economics, there's a short, there's a medium, and there's a long term. In America, folks, we partition out short term and long term. Is the confusion here about the Fed and the market has one definition of short, medium, and long term, and the Fed has a different one?
Yeah, I mean, I think the market has been very impatient to jump to the conclusions about inflation and labor supply, when in fact it's going to take a long time to sort through some of the frictions of the wildest swings in demand we've ever seen. Of course, the economy is experiencing some frictions. We rebooted the global economy, so there's going to be a lot of noise and a lot of, in both directions in the data. I think it's important to remember we've been seeing surprises on inflation in one direction that can easily surprise in the other in the latter half of the year. So there's just going to be a lot of swings, and the Fed is trying very hard to carve out room for patients to interpret that frictionful recovery, reopening, before jumping to conclusions and setting a course that will turn out to be wrong.
Julia, how problematic is it for the Federal Reserve that, for whatever reason, the market did respond so strongly to a number of hawkish dots, and that the response was lower break-even rates, lower expectations for inflation over the longer term, exactly what the Fed does not want to see? How much does this actually tie the Fed's hands?
Right. So I think, yeah, exactly. The reaction in inflation was probably not exactly what they intended. The flattening of the curve was not exactly what they're shooting for. But again, they are patient. This is a few days of market reaction. I think that they want to emphasize that this isn't a more hawkish reaction function. But in fact, if they do move later, it will be because the economy is so strong. And that will be good news that they're here to accommodate the recovery, not stop it in its tracks. So I think that may be some of the clarification that we hear from Powell through the course of the Q&A. Of course, we already have the testimony. It's very much sort of a repeat of the official opening of his press conference. So it'll be the nuances in the Q&A and how he really addresses some of the questions. Of course, lawmakers from each side will try to be pulling him over to their side. Don't we have enough fiscal? Don't we have not enough? And Chair Powell will meanwhile be, illuminating his views on the dynamics of the economy. And I think Powell is very optimistic that we are going to get a robust labor market recovery, that inflation will be contained, and that what we'll see is a faster and stronger recovery than we saw last time. And that's the ultimate objective here.
Julia, what would your top question be this afternoon?
My question would be around this debate on the tightness of the labor market. I think it's pretty wild to be calling a labor market with so many millions of people actively looking for work and very many other millions others on the cusp of the sidelines tight. I think we know that there's some repricing in certain occupations. So I'm on camp not tight, camp we can go a lot further. But I would like to hear where Powell comes down, because I do think a question like that would get at the heart of his dovishness on the labor market and really tell us where the leadership stands on that very critical issue. If you think inflation is not going to be transitory, it's because you think the labor market is tight and we've tapped out earlier than we might hope. And there are people on the committee that do believe that. We hear that view. We heard it from President Bullard yesterday, that the labor market is much tighter than you think. A lot of these people won't come back. This is what it is. And I would try to ask Powell where he thinks the labor market is and how tight does he think it's going to be.
Julia, thank you. Got to leave it there. Julia Coronado there of Macro Policy Perspectives. Lisa, when's that 2 Eastern this afternoon?
2 p.m. Eastern. And this will be really interesting to see if there's any kind of market response to a more dovish tilt, or whether people have basically gotten this out of their system. They're reflating the reflation trade.
Look at this bond market. These moves. 135 at the lows in yesterday's session, Tom. 159 at the highs on Thursday. That's quite a range over a couple of days.
Yeah, the dynamics are extraordinary, and you see it in spread. I took a careful look today, John, at the real yield, because I know you're going to be back Friday doing the real yield. And, it's come in, but the real telltale sign here is, do we break through to a lesser negative, a higher real yield? And that really hasn't happened yet.
Your nominal yield right now, 147.51. I can see on this pillar in front of me, Tom, Dow Futures made a comeback.
That's what we did.
When I was away.
Roman, thank you.
Okay.
Roman read a memo of
We'll see
mine.
how long that lasts. America's benchmark.
We're going to embrace you, John, in the Dow.
Down not even
I'm getting you Dow pajamas.
a tenth of 1% at 42.14.
The Dow pajamas, John. They have all the old Dow members.
You get me some PJs, Tom. I'll go back to bed. How's that?
You can wear them on Love Island.
From New York City. We'll talk about Love Island a little bit later, shall we, Tom? Is that making a comeback?
We shall.
You excited for that? Lovely. Good to be back Tuesday morning. Good morning. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population, but cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. Mercado Libre CEO Marcus Galperin says he sees a really enormous opportunity in fintech. He spoke exclusively to Bloomberg's Eric Schatzker last month about his company's growth prospects and opportunities in digital payments.
It's not like we need to replace, the credit card system. We need to replace cash, and everybody wants to replace cash. So I think the opportunity in fintech is really enormous, and we look forward to capturing a small percentage of that really enormous opportunity in fintech.
Galperin also tells Bloomberg that he doesn't think anyone should, quote, have a considerable portion of their net worth in crypto, because it's still a very early stage and very volatile. Italy's health minister says the country will end its mandatory use of face masks in open spaces for its low-risk zones starting June 28th. Italy was the original European epicenter of the outbreak. The minister says the government will continue to follow medical expert guidelines on safety. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
there's no question that the Fed needs to go into a period of normalizing rates and normalizing the portfolio. And I think the question is really how quickly they do that and how they do that in an effort to control inflation.
That was Stephen Mnuchin there, the former US Treasury Secretary, speaking at the Qatar Economic Forum just yesterday. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferrell. Tuesday morning price action shaping up as follows on the S&P. We're down a single point, off by not even 0.1% on the S&P 500 after a really tidy snapback in yesterday's session, breaking 4 straight days of losses on the S&P 500. Outside of that, into the bond market, yields lower by a basis point, 147.51, really volatile over the last couple of days. That's for sure. Big bounce back in yields at the back end of last week, Tom. And then the big bounce up in treasuries, rather, and then yields coming back again. Can't make this one up.
You're rusty.
At all, I know.
You need a couple
days. Just trying to get there, Tom. Work out where we've been, where we're going. Get philosophical. Euro dollar 118.90, down 0.2%.
John, we do yield to 4 digits here. That's all you got to remember.
I'll try and remember that. Where are we now?
He's giving you
space. 17.
Okay.
147. 1.7.
Did you do your expenses yet?
Yields in. You know what, Tom? I haven't. I actually called Jamie last week when I got my email shut off, and I said, Jamie, can you give me an extra week? And Jamie gave me an extra week, and my expenses are about this long.
A little inside baseball.
Did you do the training, the internal training?
No,
get
I
that
did
done?
not.
I've got to do that too. So there you go.
Folks, it's a Surveillance Break exclusive. I have done all my internal training, and part of that is to leave John alone on the Dow Jones Futures to -10 right now. Right now, we are voting in New York. Shelley Banjo will join us here, I believe, in the next hour. She's truly expert on New York City voting and ranked choice. Right now, Martin Schenker joins us. He's Bloomberg editor-at-large and in charge of most of our visibility in Washington. Marty, I would suggest this is 56th Street, is right where we're voting key here. And this is really historic. The Industrial Arts School of New York City, a really famed school. This goes back to the fashion designer Marc Jacobs, and farther back than that, more downtown, I believe, to great Tony Bennett, who is 94 today. So that's a landmark in New York with a landmark election. Martin Schenker, Washington. This is a week where red lines will be drawn. We can start with voting rights or anything else. The power play is going to begin to sort out, isn't it?
Yeah, it's not just voting rights bill, which they need a unified Democratic Party in the Senate to get passed. And even then, you still have the filibuster. So that bill is probably dead on arrival.
Okay, but there's other bills as well.
Yeah.
And what we're talking about here is the polarity of a united Republican group, I would suggest, and then different parts of the Democratic Party. How's that? Where's that dynamic going to be in August or September?
Well, I think this whole infrastructure bipartisan deal is going to tell a lot about where the politics goes from really through the rest of the Biden administration's first term. If they can get a deal, if they can figure out how to finance it without running afoul of Joe Biden's feelings about this, then I think that they can actually make some constructive progress. But, I do think it's quite possible if they can figure out how to fund it.
All right, $579 billion. We were talking about this yesterday, Marty.
Yeah.
A far cry from some of the previous proposals, and yet people are still talking about a multi-trillion-dollar fiscal stimulus from Joe Biden. What are the chances that we actually do get a significant-sized fiscal stimulus right now, given the emphasis on a bipartisan solution?
Well, as I just said, I do think it's quite possible if they can figure out a way to fund it. And it does look like the bipartisan group is trying, is taking away this whole notion of an increase in the gas tax to find different ways of funding it, that they are moving towards an agreement on that. Now, $579 billion is actually not a small number, but these days it seems like that, which is pretty amazing when you think about it.
So just to dovetail, going back to what you were saying about the Voting Rights Act and the fact that Tom was mentioning that today during the New York City Democratic primary race, there's a question of whether ranked votership is going to get broader appeal beyond New York City and could even be the way of presidential elections. Is there any discussion about that? How closely are the New York races being scrutinized?
I think there's quite a bit of attention on the whole notion of ranked voting, and it's somewhat controversial. There are a lot of people who feel that, we should just vote for the person we want to be hold that office, and it's a very simple choice. I do think that a lot of people are going to go into the voting booths today and be really confused about what they're supposed to do. So you may see long lines, not because of participation, but because the amount of time it's going to take to fill in those ballots.
Marty, got to swing back to Washington with this headline just out. White House says they may invite senators to infrastructure talks. That from Punchbowl this morning. Okay, they may invite senators to infrastructure talks. Is the Biden administration doing an end around of Senate leadership and House leadership?
Well, no, as I've said a few times, I really do think Joe Biden wants a bipartisan infrastructure deal. It's not just lip service.
Is Senator Schumer in support of a bipartisan group of senators meeting with the president?
I would think that Chuck Schumer would be supportive of anything Joe Biden wants to get done. And, they can move on to the bigger stimulus later.
One final question. Did you miss John?
Oh, I absolutely did.
Yeah, I know. We were tearing up.
Thanks, Marty. Appreciate that. I believe Marty. I don't believe you, TK. Marty Schenker there, Bloomberg editor at large. Tom, since I forgot whether Treasuries rallied or sold off last week.
4 digits, John.
Yeah,
but,
I've got to catch up. Can you tell me what's going on with these infrastructure talks? Where are we?
Where we are is normal, healthy American politics. And as Mr. Schenker wisely said, the great American tradition, and this goes back to a canal in Georgetown and George Washington of a few years ago. John, this is when the colonies moved away from the motherland.
There was more that happened.
And John, it's just simple. We've argued about who's going to pay for this stuff since time began.
Lisa, I forgot that I should ask you and I shouldn't ask you.
I don't know what you just got there. You got some kind of history there. Mayflower was brought into this. You did miss something. And this is a huge shift in tone with the infrastructure discussions, away from a headline of $1 trillion, $1.2 trillion. We're now down to $579 billion, with a question mark around whether anything else could get a follow-on from that. To me, that's a big shift. I mean, we're talking about a very big change in the headline number and, frankly, the awareness of paying for things.
John, Lisa's so fully briefed. Why don't you continue with her? I'm going to look up and see what Padres Dodgers did last night.
Thank you, Tom. Treasuries rallied last week. Just looking at the price action now, Lisa. Probably should have done this before the show. I did. I'm joking. Just in case anyone takes me too seriously and thinks, why has he come back?
Yeah.
Your 10-year, 143.81 at a close on Friday. Then, Lisa, we dropped to 135 in yesterday's session. And then we bounced back to 148.86 this morning, 147. What do you make of that? Just a positioning story last week. We cleared it out, cleaned things out a little bit, cleared the decks.
People are putting faith in the positioning story as well as the global disinflationary environment. The idea that because rates are so low internationally, you see a lot more foreign flows coming into the U.S. That said, there is a dissonance between risk assets rallying and the pretty negative message on the economy that the bond markets are sending.
Yeah.
What? Tom, you want to give us an update on the Padres?
Yeah, Dodgers 2, Padres 6. Machado just killed it. I mean, he's just on fire.
John's thrilled.
Good stuff.
Ball. There you go.
Do
John,
we do
this
football?
is baseball.
Are we still doing football?
No.
No, that was I thought that was basketball.
Okay, we got to do soccer. Well, we'll do soccer when we come back.
Okay.
We'll do soccer. It's called soccer.
Got excised.
From New York City this morning, good morning. Here's some of the price action on the S&P after a big bounce back yesterday on the S&P 500. These cyclical parts of the market, energy financials leading the gains. This morning, we're lower by not even 0.1% on the S&P. We're down about 2 points. On the Nasdaq, we're off by about 7. Again, down by not even 0.1%. And on the Russell there, the small caps, just a little bit softer, down 1/3%. Switch up the board and get to the bond market. 2s, 10s and 30s in treasuries. Are we confusing just a subtle shift in the outlook from the Federal Reserve, a more balanced outlook with a shift in the reaction function? That was the take of a lot of people. Confusing the former with the latter, and the latter is far more significant than the former right now. Your yield on the 10-year, 147, huge range over the last couple of days. On a 30-year, back to about 2.1%. Yields coming in a couple of basis points, just a little bit of a flatter curve in today's session at least. Let's finish on this. Dollar strength the story through G10. Euro dollar right now. Euro dollar 118.91, down 0.2%, reflecting that stronger dollar story. But at 119, Tom, this isn't a massive change and a big move away from where people expect expect this currency pair to finish the year. In our survey, we're looking for about 122 year-end. Right now, 118.90 on euro dollar.
Yeah, we'll do it later. JP Morgan really resets this morning to much weaker yen and much weaker euro against the dollar. They call it a watershed event. We'll get to that here in a moment. Right now in the equity markets, this is what is needed. Somebody with a long-term perspective who's been right about participating in the market. Steve Auth has a little bit of experience at Federated Hermes as their Chief Investment Officer for Equities, and he joins us right now. Steve, I want to look at the 12-month trailing of this unloved bull market, and it's real simple. Up 30%, up 36%, NASDAQ 100 up 40% as well. How unloved is this unloved bull market?
It's still pretty unloved, Tommy, as you know. I mean, that's sort of one of our several arguments for why we think we're in a long-term bull trend here. That you start with a base of a lot of skepticism. A lot of people got burned in 07, 08, and even the bear market back in 2000. So we've got this kind of generation just starting to come back into equities. Stocks, in our view, are actually still pretty inexpensive. We've got the S&P earnings next year. We just increase them again to $250 a share next year. So the market's not that pricey. The key risk now, I think, and I'm using a lot of the old dogs, as you kind of politely called us, we're actually happy with the Fed Powell testimony last week. Is our concern is that the Fed makes a policy error here and reacts too slowly, causes a massive bubble, and then has to really slam the brakes. The whole thing ends in tears. So I think we can prolong this recovery and the market if they just start taking their feet off the pedal here. Okay, I want to get this. This is a really important insight for radio and television. If you take the $250 of Federated and Mr. Auth, that gets you to a present price earnings ratio of the S&P 500 of 16.84, which is a number, I think a huge number of listeners and watchers don't see that we're at right now. That's where Mr. Auth says we are in a relatively cheap market. Steve, I got to rip up the script. If we get a Fed that's Authian aggressive, and they tighten up here sooner or later, should we fear what equities do? I don't think so. I mean, I know Ray Dalio was mentioning that. I think... well, talk about that. Is Ray Dalio wrong? Well, I think he's right to think that the risk here is that the Fed makes a mistake and waits too long. But I do think, what I think he's a little bit wrong on is, I think he's overreacting to the little bit of a pullback last week that happened when the Fed began to act. The market will always pull back initially when the Fed indicates, hey, the punch bowl might be getting withdrawn. But I think once cooler heads prevailed, I think the prevailing view, at least for me, is that if the Fed, they're not going to overreact here, clearly. I mean, they've got all these employment indicators that they're watching that are causing them to go slow. We have our whole set of dashboard of employment indicators we're watching and try to project what they're going to do next. But as long as they start doing something, even start thinking about thinking, which is what we got last week, and I kept telling my staff, just let's hope they start thinking again. And I think last week they announced that they're thinking. That's good.
Well, Steve, thank you for the update that they're thinking. I think they're talking about it. So, Steve, I think what people want to know from you, sir, is what do you want to own in this environment? Is it growth equities or the cyclicals, the banks, or big tech? Which one is it?
I want to own the cyclicals. I'm still on this trade, John, since last September. I think they're going to power higher here. They've had a nice rest. I look at all my favorite names in commodities, energy, financials. They all had pullbacks in the last few weeks of 8 to even in one case 20%. So we've had a nice little correction here in those names. The Fed is not going to kill this recovery. We've got GDP growth this year and next, very, very strong. Inflation is going to be very high this year and probably above trend next year. That's going to help those stocks. And they're still cheap if you look at them relative to where they could trade, honestly. So I see them as heading higher and leading this recovery out. The tech stocks, look, those are the long-term growth stocks. They're going to grow their way into their earnings valuations eventually. But right now, they become almost inverse treasury yield plays. We saw that last week. That was the knee jerk when the 10-year came down into the low 140s.
Well, Steve, let's
we
talk
had a
about
rally.
that relationship between rates and what may or may not happen with the equity market. Does your cyclical call need the bond market to cooperate? Do you need high yields?
It partly, the financials for sure. I definitely need higher, a wider yield curve spread, but I certainly would help a lot to get the 10-year up to 2.5, which is where we think we're going to probably end the year. Maybe get into 3 next year, which the market can sustain that as long as we get there gradually. And you're right, the cyclical trade kind of needs those higher yields. And so if you think bonds have tapped out here, I think you do want to go long the growth stocks. We still own them in our portfolios. We never went underweight. We just took it down to neutral after being overweight a long time. But we think there's still time to get back into those names, probably 6 to 12 more months, frankly.
One thing that I was struck by in the price action over the past week is that risk assets were pretty unfazed by the idea of tapering bond purchases pretty quickly, potentially even as quickly as within 6 months if we got to that late 2022 projection from Jim Bullard. Why is that? Is there a dissonance here? Is this just basically risk assets shrugging this off and saying, not going to happen?
I don't know, Lisa. I think, there's different people have different views on this, but I think the folks with a little more experience that where we've lived through some of these big bubbles in the past, the Japan bubble in the 90s, the Southeast Asian bubble, even 73, 74, we know that the risk here is that the Fed does nothing, creates an inflationary bubble that, yes, they know they have the tools. They keep telling us they know how to deal with this. But the way to deal with that at that point is to cause a massive recession after you've already got everybody loaded up in stocks. And that's not a good outcome. So I think it's actually long-term bullish, maybe short-term choppy as we digest the idea that the Fed is going to start pulling back. I think this idea that they're introducing of late 2023 as their first Fed funds hike is probably unrealistic. But at least they're starting to talk about it. My guess is we get the first hike either late this year or early next year.
Wait, seriously? Late this year or early next year, meaning that the taper has to start sooner. The reason why I'm harping on this idea of the dissonance between bond markets and stock markets is because it seems like the bond market is not comforted by a sooner taper, by the idea of curtailing some of the froth in markets. Because frankly, the message from the bond market is a narrower yield curve, is lower long-term inflation expectations. That's the opposite of the Fed acting prudently to get ahead of inflation and not having to abruptly stop a rally and abruptly poke some bubbles. There is a question here about how long this dissonance can last, especially if you see rate hikes as soon as later this year.
Right. Well, later this year, I might have gotten a little carried away there, but let's at least say sometime in the first half of 2023, I think probably is likely.
Steve,
the bond
you can't
market,
do that. You can't say later this
expect-
year, then go maybe the first half of 23.
I said later this year, early next year, something like that.
Next
But later
year's
this year might be a little.
2022.
I might have got a little excited, but certainly by later this year, being forward 6 months looking, by later this year, I think most people will digest the idea that there's going to be a hike in the first half of 2023.
Okay.
And to me, I'm always like 6 months ahead of where the puck is heading. I think that's where the market prices. So that's kind of what I'm thinking.
Puck, John, is ice hockey.
Thanks for that, Tom. Steve, I'm feeling rusty, so I'm feeling kind as well. So you run. Stephen Orth, Federated Hermes Chief Investment Officer for Equities. Did we settle on that, Lisa? Is it early next year, 23?
Late
what
this year, next year. I think he's saying first half of 2023 markets are trading ahead of that. I think. Yes, Tom?
I wasn't convinced of an entry point there. The last 10 years per year for the Standard & Poor's 500, John, 15.95% per year. I think we can round that up to 16% a year.
And Steve Orth has been bullish.
It's a single digit.
Through much of that bull
you can't
market.
make money in stocks.
I'm sorry. I don't see how stocks can keep rallying if they taper within 6 months the entirety of each monthly $120 billion of purchases. Sean, do you buy that? That you could see risk assets continue to rally?
Not for me to buy, not for me to sell. I think it's a question worth asking. Can risk assets do well
we just get into these
with reduction of asset purchases? I'm not in a position to say whether you should buy or sell the market based on a reduction of asset purchases. Did the equity market do okay last time around? When did it really start to suffer? Really started to suffer when they started to reduce the balance sheet, when they started to push rates through what most people consider to be neutral. That's when things got really dicey in this market last time around.
John, we're making jokes about it, but like Zero Hedge features Michael Wilson over at Morgan Stanley talking about if you see an M2 reduction, he understands it's debatable and that. This goes back to Tony Dwyer. Is there a recession? No. Own stocks. That's sophisticated Dwyer analysis. Well, John, what it goes to me, and this goes to the dynamics of the market, it's the pendulum of taper.
The pendulum of taper. That Mike Wilson of Morgan Stanley, I think, makes a good point.
That was a theme.
Thanks,
But
Tom.
remember, we're not talking about the reduction of the balance sheet.
Yeah.
No,
we're
we're not.
talking
We're
about
talking
the reduction of monthly purchases.
The
There is a
pendulum of
difference.
taper was
That is.
season 5, Game of Thrones, I think episode 4.
Coming up, I've missed this.
Have you?
No. Dr. Amish Adalja, Johns Hopkins Center for House Security Senior Scholar. Your equity market down about 2 points on the S&P from New York City. For our audience worldwide, alongside Tom Keene, Lisa Abramowicz.
That's New York City, John.
I'm
On radio, it's
Jonathan
a
Ferrell.
beautiful, beautiful
Clean streets.
This is Bloomberg.
And that's the Empire State Building.
With the First Word News, I'm Ritika Gupta. The bipartisan group of senators working on an infrastructure deal say they're getting closer to an agreement. But they say they're still trying to figure out how to pay for the plan, considering White House opposition to indexing the gas tax to inflation. The lawmakers are set to meet White House officials today and plan to draw up a framework for a proposal this week. ExxonMobil is said to be preparing to cut some jobs at its U.S. offices, Bloomberg's learned. An evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them in the U.S. An NFL player, Carl Nassib, has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private, but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide among LGBTQ plus youth. Global banks like HSBC and Standard Chartered are ramping up hiring ahead of the so-called Wealth Connect link between Hong Kong and China. The plan will allow investment across the border and could open up more than $460 million in annual fees for lenders. HSBC is set to hire up to 400 people in Hong Kong, while Standard Chartered is looking at hiring or promoting 3,000 Asia wealth managers. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
United Kingdom is pretty highly vaccinated, but is also now seeing an increase in infections, and overwhelmingly these infections are the Delta variant. So this is sort of the next chapter of the COVID pandemic, and just reminds us that for every move that humans make, the virus has another one, and we just have to continue to press the case against the pandemic.
It's the never-ending pandemic with Joshua Schaufstein there, the Johns Hopkins Bloomberg School of Public Health Vice Dean. From New York City this morning, good morning. Alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferrell. Tuesday morning, price action as follows. Slightly positive on the S&P 500, 4214 on the S&P 500. About as exciting as I make it out to be. Yields coming in a couple of basis points, 146.83. Euro dollar with a break of 119. Some dollar strength out there through G10, Tom. 118.97. Euro dollar coming down about 0.2 of 1%.
An important conversation, John Farrell. Maybe you've got some update on this with your travels over the last 3 weeks. There's a lot of effort to open up economies. I believe I saw in Italy they're really making an effort to open up. And then in the FT 2 days ago, John Murdoch said, wait a minute, Italy's one of the biggest headaches. I'm lost. So are you. Let's get smarter. Amish Adalja joins us now from Johns Hopkins. Dr. Adalja, which is it right now? Is it economies and societies that can open up, or because of the India Delta variant, they cannot? Which is it?
It all depends upon the state of vaccination in your country. if you are a country that's highly vaccinated, like the U.S. is, where your high-risk population, the majority of which is now vaccinated, the Delta variant is going to cause problems, but it's not going to put you into crisis. But if you're a country where there's not enough of your elderly population vaccinated, the Delta variant could put your hospitals back to where they were in the very beginning of this pandemic. So that's really what's going to gauge how the Delta variant affects a country, is how much of their population is vaccinated, especially that high-risk that high-risk portion.
Is there value for Americans to study the dynamics out of England? Is there value to really looking precinct to precinct and whatever in England at how the variant's working? Does that come right over to the United States?
I do think there's value because England is a highly vaccinated country, a country in which their high-risk population has largely been vaccinated. And what you're seeing there is the Delta variant increasing in cases, coming to dominate, but not necessarily translating into hospitals in crisis or a high level of deaths. So this is that concept I talked about before of the decoupling of cases from hospitalizations and deaths. That's what's happening in England. That's what will happen in other places where the Delta variant appears and the high-risk population is vaccinated. So to me, I think it's very important to be aggressive with the Delta variant, but it's not something that has the capacity to put our hospitals in crisis. It's going to be a very different flavor than prior increases in cases. But it's inevitable that we'll see upticks in places where there are not enough vaccinated people.
Dr. Adalja, is the sense that the Delta variant is more virulent, that it has longer lasting implications for people who are not vaccinated? What is the distinction of the Delta?
The distinction is that it's more contagious. It seems to be more contagious than any of the other variants that we've seen, and obviously more contagious than the original version of the virus. There is some mixed data on whether or not it's more or less deadly than the other versions of this virus, but that sometimes is something that doesn't pan out when you actually look at the data. But this is something that can take off in an unvaccinated population, and that's why where we have pockets of unvaccinated individuals, it's really important for them to get vaccinated, because the more we're vaccinated in this country, the less we have to worry about the Delta variant or really any other variant.
This has been the message from health officials, business officials, and community leaders across the board. There is a question, though, of how we are recording who has gotten vaccinated and the ongoing honor system that the United States is following. Do you think the honor system is the way to go, or should there be a more formal process of tracking those who've been vaccinated and those who have not been?
Well, it's important to remember that when you get vaccinated, your state, there's an immunization registry. So that's all recorded. That's where the CDC gets its numbers. So those numbers are correct. But there's nothing on your person that you have that really tells people that you're vaccinated. You have these flimsy cards that are really not anything that can be considered an official document. I do think that this was an opportunity early on that the government should have thought about. Is there a way just to have an app on people's phone that tells them their vaccination status so people can trust it? New York State did something called the Excelsior Pass, but it really didn't take off. So I think that this is something we really should see private industry innovating to put your vaccination records in an app, not just COVID-19, but all of them. I think would be really good.
Yeah, Amish, I think a huge body of our viewers and listeners agree, Amish, with what you just said. And to me, the 2-minute drill is who's going to drive this forward. Are you telling me American Airlines is going to set public policy for America?
I do think it's probably going to come from the private sector, because the Biden administration has said that they don't want to do anything like this. You might see some states do it. The International Association of Travel Agents has been working on some apps. So I do think you're going to see one of those companies come out with an app where they can verify it, and then that kind of becomes the standard.
Lisa, let's go to our other guest here this morning. Jonathan Farrell's been traveling recently. John, forget about it. You're living it. What's it like on an airplane or getting on and off where you don't know if the guy next to you is vaccinated? Full disclosure, folks, Ferrell is vaccinated.
Look, I think, personally, Tom, I think it's an absolute disgrace that we still haven't sorted out the travel corridor between London and New York. I think it's ridiculous. You mentioned the private solution. I'm sure the likes of American Airlines, United, Delta would love to sort something out like that from London to New York. The fact of the matter is, we're still shut down. It was really interesting to see the president go with his delegation and a bunch of journalists over to London, over to Cornwall the other week, wasn't it? And then go over to Geneva. And then we had the theatre of the mask and the elbow bumps in the UK, and then over to Geneva without a mask and the handshakes. I've got to say, Doctor, for a lot of people, it's incredibly frustrating. And I don't want to get too personal about the matter right now, but I do want your opinion on why on earth we haven't addressed this travel situation.
It's really mind-boggling. I think now with fully vaccinated individuals, they can go back to their pre-pandemic life. They should be able to travel freely without testing, without quarantine. That needs to be the standard. It's just that these countries are on different timescales, and a lot of them are reticent. Just look at Canada. They will not let Americans in that are fully vaccinated. It really makes no sense to me, and I think we have to start moving past this pandemic, this acute phase of the pandemic, because if you're why did you get fully vaccinated if you actually don't get the ability to kind of have your ability to move around the world back? So I think this is something we need to address, and I know they're working hard to figure this out, but it's going to take some time.
Doctor, got to run. Thank you.
Yeah.
Dr. Amish Adalja, Johns
Wonderful.
Hopkins Center for Health Security Senior Scholar. That's something, Tom, that is not going to get addressed anytime soon.
John, I still can't believe we're not doing Heathrow to New York. I mean, you've been leading on this for a year and a half. Now, John, we got to go through this cycle here because I've had a lot of mail on this and people are thrilled you're back, blah, blah, blah. We failed last week, John. We're on radio. And, folks, dead silence on radio is a failure. I asked Romain Bostic about soccer. And there was complete.
Just got nothing back.
He didn't even fake it like me. I mean, Romain's just
Who is the failure on,
dead.
Tom?
Romain
just
is
saying.
just like complete.
Yes, exactly.
Total silence. Now, John, let's go to Euro 2020. Today's a big day. The only reason Farrell's back is to go out to the Bohemian Bar, Hall, I should say, at 3 p.m. and watch Czech England and all that. But the issue, John, is the uproar. Is Harry Kane
Does he play
fit?
or not?
Is he
Does he
fit?
play or not?
Well, I'm asking.
I don't know. I have to say, you know the difference between England and Italy?
Yeah.
Is that Italy always has a philosophy, a team, a strategy, and England just tries to play its best players at all times.
Exactly.
And it never works
we
out.
miss this, Lisa. We miss this. He thinks we're serious.
The pendulum of football.
Coming up, Hannah
you can tell when
Wells
someone's
Fargo.
fit.
Thanks, Tom. The S&P 4213 from New York City.
I think Harry Kane.
What's my out? The 56th minute.
Yeah.
Come on, we're almost there.
You got this.
There we go.
Really?
This is Bloomberg.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
We have an economy that's really strong. It's not normal to have rates at these low levels.
What the Fed is actually concerned about is that after 2023, you're going to see continued increases in inflation.
Given the rise of inflation, the hawks are more willing to show their hands.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferrell, and Lisa Abramowicz.
From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferrell. Equity futures unchanged on the S&P 500, 4213. A little bit later this afternoon, Tom, Chairman Powell going down to Capitol Hill to testify.
He's got a lot to say, and of course, all these different officials that we have to cover up the damage of the last number of days. And the message, John, is a time continuum. And I think really what's important with Powell is to see, is he focused on 21? No. Is he focused on 22 or even out to 23, 24? John, while you were gone in your sabbatical, David Folkert's Landau had the courage to go out to 2024, and they see higher inflation.
I'm not sure anyone's calling it a sabbatical, but thank you, Tom.
That's
the
okay.
S&P 4215 on the S&P 500. I'll let that go. Don't worry. You talk about the damage done to this market, Tom. What damage? Where is it?
Well, the damage, exactly. The drawdown in the S&P 500 is less than 1%. There's a lot of people saying death of the bull market. Steve Auth in the last hour I thought was great on that. There's a raging debate. I don't know what to do with Anna Hahn here in a minute, but the bottom line is if you're not in the game, you can't play.
Yeah, and we're always focused on the dumpster fire, aren't we?
Yeah,
so the
exactly.
dumpster fire for about 5 minutes in the equity market. What happened in credit? Lisa,
Yeah,
what happened in credit?
Absolutely nothing. Basically wide open. It was completely calm. Rallied, spreads tightened right back after a brief moment of, I wonder what's going on. When Tom talks about damage control, I have been wondering this. Where was the damage? Why aren't Fed officials cheering the response? A little bit of froth taken off the top, a bit of skepticism around how long the Fed will keep the pedal to the metal. This is a good thing for the Fed. But that said, the fact that longer-term inflation expectations came down is not good.
Yeah.
And if they're going to do damage control, John, that's where they're going to do it.
John, Liz Ann Saunders was just out on Twitter. 95% of SPX went up yesterday. 95%.
Damage control.
That was a jump condition sea change.
If I was concerned about one thing over at the Fed, it would be how quickly some people, and I emphasize some people, believe that the Federal Reserve had somehow shifted the reaction function on a very, very nuanced, subtle move in last week's news conference and in the summary of economic projections, and that's not what happened. And if they've spent more than a year on this, Tom, more than a year talking about this shift in this reaction function, for how people question it off the back of one news conference, one decision, that's probably not good news for them.
You know, I know we got to do data and brief and get to Anaheim, but one of her great themes here is the economy will deliver for Chairman Powell. That's different than a lot of other worry that's out there.
Let's turn to this market right now. 42.14 on the S&P 500. Futures largely unchanged. In a bond market, there was a rally in the Treasury market last week. 147.34 is where we are. Yields coming in about a basis point or two on a 10-year. And in foreign exchange, dollar strength the story right now. Euro dollar 118.93. Lisa down 0.2%.
Yeah, really, really dramatic market here to greet you, John. Not a lot going on. Markets trying to refine some sort of level after that drama that Tom was talking about last week. All right, today, New York City is holding their Democratic mayoral primary election. Key questions here, in addition to crime, safety, and the ranked voting, is how do the biggest cities recover from the pandemic? How do we get back to an office culture? What does that look like in a more remote working environment? Then at 1 p.m., the U.S. is planning to sell $60 billion of two-year notes. Interesting to see after yields on those securities rose to the highest level since March. If people are forecasting an early 2023 rate hike, what does that look like for the two-year, and how messy is this auction? And then at 2 p.m., the Fed Chair Jay Powell is testifying to the House. Interested to see what damage he sees to control. So sort of the discussion we were having earlier, what he emphasizes, how much he plans to emphasize transitory, and also the dispersion of views on the Federal Reserve. Should this give the market some confidence in some ways, John, that at least the Fed is recognizing the inflationary risks and they're not going to necessarily let things get over their skis and then have to come in with force, raising rates and committing a policy error?
So, Lisa, which one is it? Has the balance of risks around the outlook changed, or has the outlook changed? Is that the same thing?
The issue here is that suddenly the Fed seems more concerned about inflation, and the dual mandate between employment and inflation seem to be weighed much more heavily to employment, with the Fed basically shrugging off inflation, saying it did not pick up over the longer term. We are hearing more true concern about inflation now, and if the dual mandate more heavily weights inflation, John, all of a sudden people think the Fed is going to have a swifter reaction function and will come in and hike earlier.
Quick word, Tom.
I just think they're making it up as they go. I really take issue with all this navel gazing about, you know, what the Fed is going to do. Is that, John, they're making it up as they go.
Tom, anyone with any confidence, any conviction about the outlook here is a charlatan. Let's be clear about that.
I'm going back to, I interviewed Richard Timberlake in our Washington, D.C. office, the giant of the Georgia School, and he was just magisterial. You know what? They put their pants on one leg at a time. It looks like everybody else, and they're making it up as they go.
Talking about making
Anna
it
Han
up.
joins us now. Wells Fargo equity strategist.
They do. Anna puts her pants on one leg at a time. They're making it up as they go.
Where's this going?
TK, you want to go there. I don't. Anna, I'm going to keep things down the middle with you.
Markets.
All right? Let's get to that equity market. Anna, has anything about your outlook shifted in the last week?
There has been some shifts, especially in the last week. What you did see is that more people on the Fed are expecting a little bit of a sooner rate hike. But, you know, that move, as much as it was a bit surprising, wasn't all that mind-blowing. You saw go from 2023 to maybe a hike at 2022. That probability distribution has been pulled forward in a time frame. But that's not the biggest move to us. I think more surprising in the market was hearing taper talk start. But, you know, when is tapering actually going to begin? We don't think that's going to happen until the end of this year.
Anna, your note is brilliant. The way you dovetail GDP in is great. I've been harping on this for a week and a half. I'm putting my pants on one leg at a time, Anna. I want you to tell me right now what Jerome Powell, putting his pants on one leg at a time, what we do with 11.3% nominal GDP. Your new statistic up 7.3% plus 4% inflation. I think that math is 11.3%. Anna, that's a boom economy. Stocks go up.
Yeah, when you looked historically, equities can go higher even as rates are moving higher. And that's because it's the level at which they're coming off of, where we're listing off of. Mind you, look at where the 10-year is. But with these kind of changes to our projection, the big driver there is going to be consumer expenditure. What may be a risk to our outlook, we're keeping a very close eye on, especially with upcoming earnings, is going to be how the supply chain and inventories hold up.
Anna, you talked about the surprise of potential tapering. What would the implication be? What's the reaction of equities should the Fed start to taper their bond purchases sooner?
Well, they're buying $120 billion a day. And I think rather than being a crutch at this point, it's just something like we've gotten so used to it. We've come dependent on it, having that liquidity. As they taper that back, I think that risk appetite will be pared back a bit. And that's natural. When you have accommodation coming off the table, people are going to have to adjust their risk outlook and see what kind of cyclical exposure they want. But that doesn't mean necessarily it's time to head for defensives. In fact, the macro theme in play still remains reflation, recovery here. It's just a bit of a little shift, and it's different mentality than we saw from a year ago.
So if you had to own one sector into year-end, Anna, would it be the financials or would it be big tech?
I would go with financials. The millennial in me still believes that tech has more upside to go. But, the outperformer here, especially in the back half of this year, of the next 6 months, I put my money on banks and financials. John.
Anna, how much is this a bet on a steepening yield curve?
That steepening yield curve has been, it's been a headwind for banks and financials in the last quarter. You saw what happens when the back came down. You saw what happened last week when that yield curve has been flattening. And it can be a challenge. But I think that's something that the market is going to get through. I think that's something that's going to see that trend return to a steepening yield curve, especially as you see more data come out. But one of the things we got to watch out for as well is, how long is that inflation going to be marred, or when can it continue? Can the supply chain really slow it down and keep that suppressed for the next several months? I think that's going to be a part of the market we look as a signal for that.
Anna, always great. Thank you. Anna Han there of Wells Fargo. Your equity market at about 7:09 Eastern Time, bouncing back a little bit, up 5-6 points on the S&P 500, advancing a little more than 1/10%. You can see the Nasdaq 100 futures here up about 1/4%. Big bounce back in the financials and energy yesterday. The bank's up by more than 2% in yesterday's session. Energy up by more than 4%. And the question of the moment, Tom, really the question of the year, what do you want to own within this equity market away from the headline benchmark, the index? Do you want to own the financials, which have done well so far, or pivot back to big growth?
Or both. I mean, and I don't have a strong belief here, John, but I do agree sector selection right now is really critical. I'd also point out, John, just in the last 4 or 5 days, moving from plus 20 down to 17.52 on the VIX right now. A VIX of 16 completely refutes the angst of the last 3 or 4 days.
17.52 right now. And Lisa, that's where the tension's been within this equity market. Will the Fed move to choke off growth? And would that shift you back towards the big growth names, the big tech names?
And will a taper actually cut off growth? I mean, that's actually something that's a big question at this point, based on your point earlier, that if they're not reducing their balance sheet, how big of an impact will this really actually have? They still are stimulating the economy by holding their balance sheet above $8 trillion.
Well, TK mentioned Mike Wilson and Morgan Stanley a little bit earlier. What's the most powerful force at play here, Lisa? The move away from peak growth, peak rate of change, so to speak, in the economy, or the move towards perhaps a tapering?
Probably the move beyond peak growth, because ultimately at this point it has to be the earnings that justify the move, and probably the liquidity in markets already is there. How quickly it will be taken out of the system remains to be seen, but earnings have to deliver,
John,
and that's what analysts say.
I strongly agree with this. I can't say enough about the linkage here into GDP. John, a research note that underscores that optimism this morning. It's a wonderful note from Paul Megacy over at JP Morgan. And John, you and I love when somebody says, I was wrong. Megacy nails that now. He went weak dollar, and he said it's wrong. We lost patience with a patient Fed. Our timing was poor. He goes out the yen, weaker, 107 to 112, and he looks again at the real yield. John, the real yield Friday, I believe, afternoon.
Thanks. I'm just sitting here in shock that you actually did something serious for a moment. I was expecting something else.
Oh, no.
Thank you.
This is serious. This is my one moment of the
4 on the
morning.
S&P. We advance 1/10%. From New York City this morning, live on TV and radio, this is
I got to
Bloomberg.
brush up on Love Island.
With the First Word News, I'm Rishka Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population, but cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. And with pandemic restrictions now being lifted across the country, companies are taking different approaches to retain staff and boost productivity. Some expect a full return to the office, while others are being a bit more flexible. Companies like Goldman Sachs and JP Morgan are requiring all vaccinated employees to be back at their desks this fall, whereas Apple and others plan a hybrid work-from-home strategy. Dating app Bumble temporarily closed this week, giving its workers, quote, a much-needed break to recover from COVID-19 burnout. In the Philippines, President Rodrigo Duterte is threatening to jail those who refuse COVID-19 vaccines. It comes as the nation ramps up inoculations to prevent the spread of the Delta variant, first identified in India. The country's Justice Secretary has countered Duterte's remarks, saying in a statement that there's no law compelling citizens to get vaccinated, and his own spokesman says vaccinations are voluntary. Several large Chinese banks are said to be restricting credit to China Evergrande Group amid mounting concerns about the developer's financial health. 3 banks with billions of dollars in combined credit exposure have reportedly decided not to renew its loans when they mature this year. In response to questions from Bloomberg, they denied lenders were curbing access to funding. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
There's upside risk to inflation. Could go higher than what I've outlined here. And we have to be ready on both sides, I think, to be able to react to that, to be state contingent, to be nimble. Just as nimble coming out of the pandemic as I think we had to be going into the pandemic.
The loudest voice in the room getting all the attention. That was Jim Bullard,
Yes,
the
well
St.
said.
Louis Fed Bank president. We're catching up with the New York Fed president, Mr. Williams, a little bit later on this morning. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferrell. Equities 42.17 on the S&P. We advance 0.1% there. In the bond market, yields basically unchanged, come in almost a basis point at 148. When you're buying a home in America, you might not be competing for that house with someone in the next town over. Maybe from someone out of state. You might be competing with the likes of Blackstone. Here's one for you guys. Blackstone Group agreeing to buy a company that buys and rents single-family homes in a $6 billion deal. The giant investment firm reaching a deal to acquire Home Partners of America, according to people familiar with the matter. The Wall Street Journal wrote a lovely article about this, I think back in spring, Lisa, about the competition for single-family homes in America, and your new competition, I say new, let's just say the competitor, is over on Wall Street.
Yeah, the idea here that it's mass purchases, sight unseen, and they're going to come in with a bid beyond what you as an individual could potentially buy. Wall Street increasingly owning Main Street homes, raising questions about rents going forward, raising questions about affordability at a time when the average home price in major metropolitan areas rose 13.2% in the year through March. Just to give you a sense of how much there has been this powerhouse behind prices
And Lisa,
of homes.
Raising questions about the social warrior status of the Federal Reserve, Tom. Are these the kind of things they want to see happen? I doubt it.
I think they're going to become overcome by events on this, and it's hugely regional. There's huge dynamics here in rentals. We're all, inured to the New York City landscape where there's a real theory of rent versus buy. But a lot of other areas are different, and the crowding out thing here, John, is tangible. There's a lot of research going on about what big institutional money means for crowding out and moving up prices.
And Tom, when it comes to the Federal Reserve and the asset purchase program, I know this is just one example, but more broadly, this is a story. Do you think this puts pressure on the Fed to remove the accommodation they're providing to the mortgage market
You're
through
right
MBS?
that it should, but no, I don't. I think
Hold
it's
on a second.
tangential.
Actually, one of the main things that stemmed from last week's meeting was that the first way that they would start to taper would be to reduce their mortgage purchases, that they would actually focus the adjustment on that level. And the mortgage market has actually underperformed pretty significantly since there. So perhaps, John, exactly to your point, the Fed is taking stock of what's going on in housing.
An example of why they might have to move, Tom.
Yes.
Another example this morning, Blackstone betting $6 billion on buying and renting homes. And let's be clear here, this is not Blackstone's fault. This is the fact, Tom, that you can't get a yield anywhere else.
Oh, we'll have to see. Right now, joining us, someone who has been extremely busy within the tri-state area, and particularly the 5 boroughs of New York City, and that is our New York City Bureau Chief, Shelley Banjo. She joins us too briefly here this morning. Shelley, if you were to provide a distinction today on this election, what is it? To me, it has been the ascent of crime, the ascent of what are we going to do about safety in the city. But what is the Shelley Banjo distinction of this vote today?
Thanks, Tom. It's a real vote on how you want the city to recover. So early on in the election cycle, you saw a rise of a candidate like Andrew Yang, who was saying, I want to bring hope and cheerfulness back to a city that's still in lockdown. Over the few months, everyone's kind of come out of their homes and realized, well, actually, maybe some of the more quality of life issues like crime, like trash on the streets, maybe some of those things are a little bit more important right now to me than some of the more ideological battles that were fought over the last 8 years in New York.
Shelley, Tom's been talking a lot about turnout, that typically with primaries, there isn't that big of a number of individuals that actually go out and vote. Do we have a sense of what turnout will be like this year?
I think that is the most important question that is on everybody's minds because there's so many different variables this time around. So already about 200,000 people voted early in the elections. It's hard to compare it because last time around there wasn't early voting. But during the presidential, 1.1 million people came out. That's always the case that there's more people for a presidential election, especially one like 2020. But it's really hard to know. Also, new things, ranked choice voting, a primary in June when it's usually in September. Just a whole bunch of changes this time around that make it harder to kind of figure out and game what's going to happen.
Traditionally, Shelley, New York City has been pretty progressive, and we see a roster of pretty progressive candidates. They are not in the lead, and in the lead is the issue of crime. Can you give us a sense how the increase in crime in New York City has readjusted, completely reshaped the landscape for politics in New York?
Yeah, politicians like to say that it's not just the crime numbers, but it's also the perception of crime that matters to people in New York, because if you perceive that things are bad, it doesn't really necessarily matter the numbers. You still don't want to go out and take the subway. You still don't want to go out to the museums. And so basically it's all tied together. There's no economic recovery until you get the crime rates down. There's no tourism. There's no jobs, there's no, any of those things until you get the crime rates down. And so that's why everything focused on crime, because people are looking around saying our unemployment is still double the country. We depend on tourism here. We depend on getting life back, Broadway, whatnot. And if you have shootings in Times Square, you can't do any of that. And so that's why crime really became such a hot topic during and continues to persist during this campaign.
As it should do. Shelley Banjo, thank you. Bloomberg, New York City Bureau Chief. Looking at this market, Tom, 42.18 on the S&P, pushing 42.19. We advance a little more than 0.1% in the equity market.
It's the way we're advancing, John, and this goes back to strategic notes, whether they're out 6 months or a year or they're out 6 hours. This idea of a grind higher, which you see on the Bloomberg terminal when you look across equities, bonds, currencies, commodities. I mean, just in oil, you've seen the same. This grind nature is back in vogue, particularly in equities.
That grind is back, Lisa, after a big bounce in yesterday's session.
Yeah, I'm struck by George Saravelos of Deutsche Bank. He put out a note this morning basically talking about bond yields being low, equity prices being high, and how this basically is being back to secular stagnation 2.0, and that is what markets are currently pricing in. My question is, how far can equities continue to churn higher in secular stagnation 2.0?
Secular stagnation, 148.35. Do you think that is screaming something bad in the bond market right now, Lisa, do you think that bond market screams anything bad, anything sinister, anything to worry about?
The messaging, I think, has gotten a bit muddied, and not necessarily by the Fed's bond purchases, that certainly, but globally, the central bank's reaction function, the fact that there's so much money and that you've got foreign investors coming in because on a relative basis, the U.S. is pretty high yielding.
Are we really questioning the Fed's reaction function after last week? Is that what's been happening, Tom?
I'm not. I'm real clear on this. It's been, it's been a roller coaster coming off of the Fed show, John. 201, things just lit up, and we lit up, down, whichever series you're looking at. But the end result here are officials calming the markets. And are we going to see that?
Yeah.
I'm going to say it, John. This John Williams interview today with you and Michael McKee is without question the interview of the day. I don't know what else to say.
I think that was a sincere promo.
It was.
Of 9:30 Eastern.
No, I mean, John, this is serious stuff.
Thank you, TK. I
the
appreciate
theoretical construct of our start is a huge deal.
From New York, this is Bloomberg. From New York, live on TV and radio, here's the price action this Tuesday morning. Good morning to you all. Equity futures advancing a little more than 0.1% on the S&P. 42.20 in sight on the S&P 500. After a nice snapback in yesterday's session, following 4 straight days of declines, energy and financials leading the gains. Speaking of the banks, the financials, can you get a nice bid into the banks if the yield curve doesn't cooperate? So let's talk about a yield curve. 5 versus 30, switch up the board. A chart that topped out back in late February, just north of 160 basis points. Right now, about 121. A severe correction last week and just a small bounce in the last 24 hours. We had Steve Orth, the Federated, on a little bit earlier this morning, talking about sticking with that long bank story, but he needs the yield curve to come with him for the ride. And so far, we have not threatened to take out those highs from late February, late March. That's the bond market. Let's finish on crude. WTI and Brent. A little bit later this morning, in about 45 minutes' time, we'll catch up with Francisco Blanche of Bank of America, talking up triple-digit crude next year. $100 a barrel, maybe. Right now, TK, on Brent, 74.52. We had a little look at 75. We've come back. On WTI, 73.15 and down about 0.7% there as well. But that's the call from Bank of America. And it's a big one.
Well, it's a big call based on GDP, John. And then to be clear, 2 years out, they come back to $65 a barrel because shock, microeconomics works, supply comes on, and down comes price.
That gets your attention in the equity market, too. Let's talk about some movers and say good morning to Taylor Riggs. Hey, Taylor.
John, we tried to get Francisco on the show yesterday. They told us you stole him for the morning show, but that's really where I wanted to start. That call at $100 a barrel. Right. You have B of A, you have Trafigura, you have Goldman sort of all making these calls of $100 a barrel is in reach. You're getting a lot of upgrades on some individual stocks, but you're not seeing the follow through as we turn unch to negative on some of the best performing stocks that we had earlier within that oil space. So let's look at a place where we are seeing some action. Norwegian Cruise Lines. This is getting an upgrade at Wolf on improving booking momentum, but that doesn't help the stock. Delta, we know that we're coming off of a really strong weekend within the travel space. They are now trying to hire about 1,000 pilots. You cannot get these people back to work fast enough. And finally, we shift to perhaps maybe some of the meme stocks. We do this just for Tom as we talk about fundamentals, trying to register an additional share sale. RBC saying that they need more cash, not enough right now for Nikola. And finally, let's take a look at MicroStrategy. What happens when you sell debt to buy Bitcoin, an average of about 37,000 a Bitcoin? Bitcoin falls to 32,000. You have a $77 million write-down, John, on the balance sheet.
Taylor, thank you. I think TK's got something to say about this.
No, just, the whole Bitcoin thing. I mean, Novogratz was on with some really important comments from our Qatar Economic Forum. And John, there it is. It's critical support. A 29,000 print is a huge deal for Bitcoin.
And TK, Taylor got up early. Promo the show.
Yeah.
You going to do that? No,
yeah,
don't fancy
so.
it? Taylor,
She'll be on
thank
this
you.
Afternoon, probably with
the
guests.
Close starts at 2 p.m., we're told. A little bit later this afternoon, every weekday.
Oh, very good, John.
Thank you, John.
All right.
Being polite.
Insert the real yield there, and it
That's
looks
the price we pay for an appearance, isn't it?
It is.
The promo.
It is.
Absolutely.
Okay,
some of our contestants stay at the Essex House. Thank you. Right now, and this is really important, this is the interview of the day that links Chairman Powell to President Biden to all the politics of this nation. If you are ever so lucky at Wellesley College long ago and far away, you studied the Cobb-Douglas production function with Carl Case, and that was a special thing. Betsy Stevenson of Wellesley and Harvard joins us now at Michigan, holding court on labor share. Betsy, labor share is a stunning trend from World War II. It's because of technology. It's because of productivity, this, that, and the other thing. Are we finally seeing a stasis or shift in labor share where they get back on board the economic pie?
Well, I mean, I don't know whether we're going to see the labor share start to climb up, but I do know that what we're starting to see is a return to workers having some bargaining power, particularly at the bottom end of the income distribution. Their services are in demand all over the shop. Those are those help wanted signs you're seeing. And we're telling these workers, not only are your services wanted today, but they're probably going to be wanted just as much or more next month. So take your time, pick your employer, start listing your demands. And they're definitely doing that. That's why we're seeing wages getting pushed up at the bottom. We're seeing people quit jobs. We saw more people quit retail jobs in the month of April than at any other time in the series history over the last 20 years. So workers definitely have some oomph in them right now. And they're using it to find a better place for themselves.
Wells Fargo was just on looking at nominal GDP over 11%, 7.3% plus like a 4% inflation rate. And I get that's an outlier call and on that. But Betsy, the bottom line is when the fiscal stimulus drifts away, when nominal GDP comes in as well, do you have a confidence that labor share increases can continue?
Well, I mean, I think that we're in the midst of a pretty great reckoning with how we've treated workers and how we've let inequality explode. I'm not at all confident that the market's going to solve that problem all on its own and that we're going to see all of a sudden a rebound of the labor share of income. I'm not confident of that. I think we're going to need policy change to actually see some permanent, real change done. But I think we are seeing what happens when we give workers some more power.
Betsy, one of the reasons why you're so brilliant, and I love speaking with you about economics, is because you dovetail the human behavior into it, that basically the choices that we make determine these broad macroeconomic changes. And as we talk about the labor market shifts, what kind of fundamental changes in behavior do you observe post-pandemic about people's choices about where to work, how many hours to work? What are we seeing so far?
So, normally when we come out of a recession, everybody is worried that there's not going to be enough jobs. And so when you get offered a job, you just take whatever you get because you don't know if there's going to be a job coming down the pipeline. This pandemic is completely different because we see that the economy is opening up and there's going to be job growth all over. So I think you see a lot of people being willing to take their time. That's very unusual in a recovery. But I think there's something that is deeper than that that's going on, which is we've all had a really, really weird and in many ways bad year and a half. And I think all sorts of people are stopping and asking themselves, should I be doing something different? I think that happens in everybody's life at some point, but I've never seen it happen to a nation all at once. And so we're seeing a great rethinking underway. And we're going to see that in the macro data because we're doing it as a macro group because we all had this correlated shock, which is the pandemic has caused us to question what we're doing with our lives.
And how does that read through to the discretionary spending, to whether people go out to eat versus eat home the way that they have been during the pandemic? I mean, all of these types of broad macro shifts, what other lifestyle changes are you observing in the data?
Well, I think that it's too soon to see what's going to be permanent and what's not. And you're certainly seeing lots of people with things fully opening up, ready to get back out there and, party like it's 1999. But there's a bunch of people who are still nervous and people who don't want to take their masks off, people who don't want to be in crowds. And I do think that there are a lot of people who psychologically, it's just going to take a little bit to get them comfortable again being in a crowd. And that's going to change their spending preferences. Look, for sure, we're seeing people finally buying clothing again. They've got those weddings that they are going to go to this summer. So maybe they should buy something new to wear. but I don't know that we're going to go back to spending in the same way. I don't know that we'll go back to buying the same kinds of things. And certainly, I think the technology shock, really the adoption of technology shock that happened over the last year, that is for sure going to stick with us. And we're not going back to the mall, to stores, to shop in the same way. I think people are trying to figure out how much are they going to continue to do remotely versus what are they going to go back and do in person. And, almost everybody I know hasn't fully figured that out yet. They have a bunch of activities that they're continuing to do remotely that they used to do in person that they're just not ready to go back to doing in person, or maybe they don't think the value proposition is there for doing it in person. So I don't think we're seeing business travel coming zooming back anytime soon.
Betsy, we've got to go. Got some breaking news. Got to leave it there. Thank you. Betsy Stevenson there. Getting some breaking news on Dr. Catherine Mann, formerly of Citigroup and, of course, the OECD as well. Catherine Mann being named to the Monetary Policy Committee over at the Bank of England, a 3-year term which will begin on the 1st of September 2021, Tom. The Dr. Catherine Mann replacing Gertan Vliega, who has served on the MPC since September 2015.
This is an inspired selection, John, and this goes to the Prime Minister at the G7 meetings as well. Catherine Mann, not only with her recent tenure at Citigroup, but also her academics, her profoundly important monograph, John, of a number of years ago, Is the Trade Deficit Sustainable? And then she did what is so rare in economic research. She topped it. Her definitive discussion of the codependencies of China and the United States will be of huge service to the Bank of England. This is truly an international choice for the England. You don't see this, John, at the Fed.
I think we should see a lot more of it. Chancellor Rishi Sunak of the UK saying, I'm very happy to announce the appointment of Dr. Catherine Mann. Her breadth of experience, Lisa, across policy research and the private sector will be immensely useful to the MPC.
I wonder if it was sort of tea leaves that she had a big map behind her head whenever she came on Bloomberg Surveillance, that was her backdrop, was a global map, and perhaps that's the view she brings as monetary policy becomes increasingly international.
Well, it does. Isn't that the story? We've got a more international outlook, and we need one for the Federal Reserve as well.
Well, that's what the Prime Minister says, John. I mean, the Prime Minister didn't mince words about it. He is looking for global Britain, and this is something, I'll be blunt, the United Kingdom does this better than the United States.
To attract the right
active
talent.
outside members coming in.
Are you just trying to make John feel comfortable?
I think he is.
No, I'm serious here. They had Adam Posen on the board.
You guys do this better than we do.
No, they had Adam Posen on the board and the rest of it.
There's a history of this, I think is what you're trying to get at, Tom. Yeah,
there is. I mean, this is really a big announcement for the internationalization of the Bank of England.
Is this how people make me feel comfortable? Your central bank's better than ours.
Seriously, this is flattery.
Not mine
style.
for you, because I'll be catching up with the New York Fed President, Mr. John Williams, a little bit later this morning. Michael McKee, of course, helping us lead that interview. That'll take place at 9:30 Eastern Time, there and thereabouts. Your S&P 500, 42.18 on the S&P. We advanced a little more than 0.1%. From New York City this morning, good morning, live on TV and radio. This is Bloomberg Surveillance.
With the First Word News, I'm Ritika Gupta. The bipartisan group of senators working on an infrastructure deal say they're getting closer to an agreement, but they say they're still trying to figure out how to pay for the plan, considering White House opposition to indexing the gas tax to inflation. The lawmakers are set to meet White House officials today and plan to draw up a framework for a proposal this week. Gamestop climbed in pre-market trading today after announcing that it completed an at-the-market offering program by selling 5 million shares for a total of more than $1.1 billion. Shares of the video game retailer surged as much as 11%, trading after the announcement. The company says it will use net proceeds from the offering for investing in growth initiatives and maintaining a strong balance sheet. Blackstone Group has agreed to buy a company that buys and rents single-family homes in a $6 billion deal, according to Dow Jones. It's a sign Wall Street believes the U.S. housing market is going to stay hot. The investment firm is said to have reached a deal to acquire Home Partners of America. That company owns more than 17,000 houses, which it rents out, and offers its tenants the chance to eventually buy. An NFL player, Karma Sieb, has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private, but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide amongst LGBTQ plus youth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rich Gupta. This is Bloomberg.
The British financial system has to do business in Asia as a whole, in China in particular, and of course that includes Hong Kong. And naturally, we don't make the laws in those countries in Asia, and certainly not in China or Hong Kong. We have to abide by the laws that are locally made, even if there are many aspects of them with which we disagree.
And apparently there are many. That was Lord Mandelson there, the Global Council Chairman, speaking to Tom Keene at the Qatar Economic Forum. From New York City this morning, good morning, alongside Tom Keene, Lisa Abramowicz, I'm Jonathan Ferro. Your equity market looks like this on the S&P 500. We add a little bit of weight to the S&P, up a little more than 4 points, advancing 4 points, up almost 0.1%. Outside of that, into the FX market, euro-dollar back with a 119 handle, some dollar strength early this morning. We give some of that up. Euro-dollar now down to 119.01 and off by 0.15%. And just quickly, Tom, your 10-year back with a 149 handle. Your yield coming in just a little bit earlier on this morning again. That move kind of fades as this session grows older, back to 149.03 on a 10-year yield.
And look where the calendar is ending here in June 30, end of the second quarter, and then we begin the earnings soiree. There's no one at Bloomberg who does earnings better than David Wilson. And David, Steve Auth, the Federated, said they've done their recalibration out front of David Wilson. $250 on S&P earnings, and you fold that into price earnings ratio to try to figure out where the market is.
Indeed, and it's something that Keith Parker at UBS did in a research report the other day, really looking at the forward price earnings ratio on the S&P 500. So you're talking about earnings estimates 12 months out and using that as a basis for valuation, and then comparing that with what's going on in the bond market, specifically the real yield, inflation adjusted on the 10-year Treasury.
Continue.
Absolutely. So what we've seen is that the forward PE on the S&P 500 has come down because earnings estimates have been going up. That's how you get that $250 number as an example. And at the same time, if you look at the past few weeks or so, that real yield has kind of hung in there. So the way that Parker's looking at things, even if you were to see that real yield move up, in other words, bond yields rising and inflation adjustment as well, then, stocks would be in a position to handle that.
And the only way to really understand this relationship is to watch the real yield at 2 p.m. on Friday.
1 p.m.
Oh, excuse me, 1 p.m. I'm sorry. I was
It's
thinking Nova Scotia time.
Yeah, well, yeah, absolutely.
John's back, David. It's that bad.
I see that.
Yeah, I see
Welcome
that.
back, John.
Lisa, save us.
Thank you, Dave. Appreciate it.
Okay, honestly, Dave, there is a question implicit in your chart here, which is something that John and Tom were talking about earlier. How important is it for us to not be at peak growth, for us not to be at peak earnings acceleration in order to keep this rally going? How much does that have to continue to make the current valuations worth it?
Well, there's no doubt that it has to continue, if only because there is so much optimism kind of built into estimates at this point. You look at the second quarter for the S&P 500, we put together the individual company projections. Analysts are anticipating earnings growth of more than 60%. Now, you can argue that number is skewed because of, last year and the pandemic really affecting a whole lot of businesses. But at the same time, you look at the shift that's gone on, people going back to some extent to the areas of growth in the stock market and backing away.
So you're observing a growth tendency here. away from value?
I mean, when you look at technology, when you look at energy, there's some of that. And at the same time, look at the economically sensitive areas of the market, finance, materials, they've suffered a bit. So, the question is, does growth kind of pick up from here? And does that bear out in terms of earnings?
David Wilson, thank you so much. Greatly appreciate it. And John, that gets over to, what's going to be growthy out there. And there's different kinds of growthy as well. All this, frankly, within the social moment that we're in is wrapped around Amazon Prime Day, I think it's called. I've never bought anything on Amazon Prime Day. I really don't get it.
Let's try and make it really simple. If the Federal Reserve moves earlier than you anticipated, and you do believe, some people do, that they might choke off growth prematurely, then growth equities become a little bit more expensive because growth becomes scarcer. That's what I think we saw last week,
but
Tom.
Anna Hahn and Steve Auth told us
they disagree.
There's another way to go here, which is, and John Writing's been great on this at Bear Stearns and at Breen Capital now, you can have a good economic and markets rate rise.
Yeah.
That's not in the zeitgeist
wants to stick with
now.
the banks, the financials. Steve Auth, the Federated, wants to stick with the banks, the financials. Lisa, Steve Auth, though, also acknowledging that for that to develop in the way that he anticipates, he needs the bond market to come with him.
What's been shocking is that stocks have moved pretty much sideways for a while now, but the rotation under the surface, we keep talking about the various rotations, it's been pretty dramatic, and this is something that Dave Wilson actually pointed out, that over the past month, real estate has gained 6.4% in the S&P 500, materials down 5.2%. John, an incredible sell-off, a sort of retracement in commodities that have been completely overblown and inflated over the past 12 months. There is a question here of how long-lasting this can be. Will the Fed, for example, curtail their mortgage bond purchases and then try to take some of the wind out of the sails of real estate and give it back into other areas? So in other words, how do they nuance this in order to affect markets in a way that they see prudent?
You mentioned real estate. Should we go back to the story of the last hour from Dow Jones, that Blackstone has agreed to buy a company that buys and rents single-family homes, a $6 billion deal to acquire Home Partners of America. Lisa, this was controversial earlier this year. It's getting even more controversial as the year progresses.
And this has been a trend that has really started off in the aftermath of the 2008 housing crisis. This idea that big Wall Street firms went in and bought mom and pop Main Street homes in bulk and then rented them out. It raises a policy question about how high rents can go. It raises a question of barriers to access for the individual to really own homes, especially at a time of such low interest rates.
Well, let's talk about the policy question. TK, the Federal Reserve has been very clear about this social warrior side of their mandate that Chairman Powell increasingly has taken on. This clearly is one of the downsides of the policy, that you start to get Wall Street getting involved in home ownership in America in a much more prominent fashion.
I'm sure they would push back and say their financialization of it provides a benefit, and as they say on their website, a path to home ownership. What I would suggest, John, is they're going to focus on the mathematics of John Williams. The R-squared debate right now is front and center, and John, this comes back to the reaffirmation of potential GDP. We had Farrell at JP Morgan tell us he stands by their low statistic, and Jan Hatzius sat in our studios, 6 days ago, and said we're going back sub 3% GDP. They're way more focused on that.
So, TK, how much daylight do you think, and I imagine you believe there's some daylight, between the likes of Bullard Kaplan and the likes of Williams?
Oh, I think there's daylight, but there's supposed to be. That's what they did in 1917 and up to McChesney Martin and the independence of the Fed. They're supposed to argue, and it's normal to be that way. I think we do the world-class best interviews of central bankers worldwide and in the United States. But this interview with John Williams is going to be intense this morning. He has to re-justify their math.
Mike McKee helping to lead that interview at 9:30 Eastern, coming up a little bit later on this morning on The Open. Coming up on this program, Binky Chada, Deutsche Bank Chief Global Strategist. Looking forward to that conversation with your S&P 500 approaching 4220 on the S&P. We advance a little more than 0.1%. Your bond market is unchanged on a 10-year maturity. Your yield is 148.86. Euro dollar back down to 118.99. From New York City, live on TV and radio for our audience worldwide. This is Bloomberg Surveillance.
The Fed is not going to kill this recovery.
Public's hype over inflation had gotten too high. The Fed got spooked.
Looking ahead, I think we're going to have real issues deciphering this data.
Given the rise of inflation, the hawks are more willing to show their hands.
If you think inflation is not going to be transitory, it's because you think the labor market is tight and we've tapped out earlier than we might hope.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferrell, and Lisa Abramowicz.
Good morning, everyone. Jonathan Farrell, Lisa Abramowicz, and Tom Keene, simulcast, Bloomberg Radio, Bloomberg Television, and news breaking here, there, and everywhere. And John, the elephant in the room to your important interview with John Williams today. We see that in about an hour, maybe 2 hours. John, there's a Hungarian central bank wanting to raise rates. That permeates this discussion and what it means for the markets.
There's another central bank in the mix. Another headline I want to get to as well, Tom, is China selling 20,000 tons of copper from state reserves July 5th to July 6th. The copper price in London correcting just a little bit, still positive on the session, Tom, at 41.94, up on the day by a little more than 1/10 of 1%.
Well, the cross currents are there, and of course, it all comes to the volatility we see, including a Dow up 500 points. You've got to be in the markets, and our guest here to start the hour has said you've got to be in the markets. John, your observation right now with the VIX 20 in seconds into 17.42.
Look, my observation is something someone close to me recalls as kindergarten macro. Kindergarten macro is when you use last week's price action to project things out several years.
I like that.
And in the bond market, that's what we saw last week, Tom, with a big correction. Then all of a sudden, people coming out and changing their views about several years out, based on a price action of a single week and a very subtle shift from the Federal Reserve.
And, of course, a lot of Fed speak we'll get today. And, of course, we're celebrating Catherine Mann being picked up by the Bank of England as a new member. That's exciting. Lisa Abramowicz, I look at it, and you have to fold it into the bond market and the observation of that deep market. Which part of the bond market, Lisa Abramowicz, matters to you right now?
Everybody's watching the yield curve to see whether it continues to flatten or whether they get a re-steepening, a sort of acceleration in longer-term growth expectations. I do just want to build on one thing, this headline about China selling copper from its state reserves. This is the first time that China has done this in a long time, in years. And it basically is a reflection of how they are concerned that high commodity prices will curtail their recovery. This is the concern. At what point will the inflation that we've seen in commodities, in certain assets, actually hamper growth, lead to this stagflationary environment that George Saravelos of Deutsche Bank was talking about in his note this morning?
That's too much linkage for me. All I know is they're unloading a lot of copper, and we'll see from that. That's out a couple weeks, actually, that they'll do that. The market's move. The VIX comes in with a vengeance, 16.80 in a full stick right now. John, the percentage changes matter. The NASDAQ 100 leading the way, a little bit up and elevated. John, what do you see?
Looking at a bond market that's just had a huge intraday trading range over the last couple of days. Yesterday was amazing, 135 at the lows. The high is pushing 150 right now, 148.69.
Yeah, and oil, 70. John, we had a 75 print on oil.
I know.
We talked about it earlier with Bank of America
10
talking
minutes.
$100
10
a
minutes
barrel.
time, Bank of America. And triple-digit crude maybe next year.
We'll see that with Francisco Blanche. Right now, and this is a joy, to bring in Bikram Chadha of Deutsche Bank, their chief global strategist. Tons to talk about in a 3-hour conversation with Binky Chadha. We'll bring it a little tight. And Binky, I want to first shout out the invention of modern Deutsche Bank strategy and economics. You guys are on fire. David Folkert's Landau is looking out 3 and 4 years to inflation. Your colleague, George Saravelos, is near term, maybe going the other way. Are you caught in the middle between DFL and Saravelos?
No, I think I wouldn't describe it as being caught in the middle. I mean, I think, if you take an issue like inflation, which we really haven't had for 50 years now, it's the most reasonable outcome is that reasonable people will have very different views, and I think that's exactly where we are. We've got a baseline view that inflation is a risk, and just that, a risk, but I think the risk, the tails are pretty fat, and I think that's the key point here.
Binky, we've had Wells Fargo on this morning, Federated on this morning, and when they are confronted the question whether you want to be long banks or big tech, they're going with the banks. Are you?
I'm long the financials and the banks. I'm also long energy. I think one of the dynamics that one needs to keep in mind over the last 18 months or so is that this is not a market that has, except for the very early part, trended very nicely. It's been a series of step functions. And so, when I look at the S&P 500 and I ask myself what's not priced in, and I would argue, it's oil prices. I would argue there's plenty of upside on, the global recovery continuing, especially if the dollar falls. Keep in mind that, you need 3% down on the trade-weighted dollar to get 10% in oil prices. So I think it's very, very reasonable that we will see $80 oil by the end of the year. And the other thing that's not priced in, and that's completely out of whack, are rates. And so you want to be long, basically, the financials. Other than that, I would be pretty careful here, and I would say, we continue basically to look for, a sizable pullback, not the mini version that we had on Friday, and that's going to hurt both the financials and energy, but we can have independent moves, oil prices and rates, simply because of where we are relative to where we can go.
Well, let's build on that, Binky. You went on a tour of the asset classes there. Can that bank's call happen independent of what happens in rates, or is it dependent on what happens in rates?
I think it is dependent on rates because, if you just look at the last 18 months, financials have been trading, very, very closely with the U.S. 10-year yield. And so the pullback is in the financials relative to the market is very easily explained by simply what's happened to the 10-year yield coming off its highs.
Binky, at the core here, there is a tension between growth and inflation, two different things that are often conflated. And we're seeing inflation as you see oil prices heading toward $80 a barrel at the end of the year, and we see it in certain commodities, which possibly is what China is responding to with selling from its strategic reserves of copper. But we're wondering how much this is asset price inflation, whether this is inflation of key goods that leads to stagflation, as your colleague George Saravelos seems to suggest. When do we have a sense of that?
I would say, stagflation clearly has two parts to it. So the first being growth. I think the key issue and point here is that, growth generally peaks, about a year into the recovery. That's kind of where we are. If you look at our house economics forecast, if you look at the consensus economics forecast, growth rates are meant to peak in the second quarter. And the stronger the second quarter is, the more likely, the sharper the peak is going to be. And I think that, there are always differences in every cycle. And the market has so far sort of diminished the peak or sort of ignored and shrugged off basically the peak growth thesis. And that's because, we have this big gap between goods and services right now. But I think anybody's investment thesis at this stage, needs to confront a very simple chart. You have a retail sales growing for 5 years, a 4% trend rate. It's nominal, purchases of goods. And if you ask, where are we today? We are 10 percentage points above the trend line. And that strongly argues for, not only slower, but very likely slow growth on the goods side. So the big question is, what's going to happen on the services side? And sure, there will be an expansion, but services don't tend to go on the other side of the trend line. And so that, on the whole, basically argues for a slow growth. On the inflation side, I would argue, this summer, yes, it is important. But remember that inflation, generally lags. So this problem's not going away. I mean, if you look at historically how inflation's behaved relative to, what people talk unemployment, the output gap, it's next year that's going to be the problem.
The great missed call of the decade or 2 decades has been the certitude of single-digit equity returns. Mm-hmm. Wrong. SPX 16% per year for the last 10 years, I think. Are we going back to a single-digit structure? I mean, everyone's predicted it, and yet you and the other optimists have said, no, you got to play. You got to be in the game.
So I would keep in mind that total returns S&P 500 last 100 years, since you did bring it up, is about 11%. It's a very, very clear trend channel.
And the Gloom crew is saying it's single digit.
Yeah, so I would say, given what's happened last year and this year, I mean, we have brought forward some of that return. So single digits, next few years is not unreasonable.
Binky Chandler in the studio from Deutsche Bank, the chief global strategist. The chief global strategist at Deutsche Bank is allowed about 6 feet away from TK. Yep. Lisa and I.
But this is, John, what I opened with there. John, what Steve Roach at Morgan Stanley did this, and DFL did this as well. Binky's writing about this, this intellectual diversity thing that's okay within a shop, John, to argue. Arguing is normal. Well, you say that, but Binky and I remembered when everybody, if they weren't on the same page, they were shot.
No, you can argue behind closed doors, Tom. You just can't argue publicly.
Steve Roach and others like David Folkers Landau said, no, we're going to do it visibly and open.
1836.
And that's great.
Coming up, Francisco Blanch, Bank of America Securities Head of Global Commodities and Derivatives Research. Just reading, it's the one thing I read, the teases.
You're just going to keep going.
Yeah.
Honestly, that'll be a really interesting conversation, and I'm wondering how much pushback he has from others in Bank of America. How about that?
Triple-digit crude.
Nailed that, Lisa.
Thanks, I'm trying.
Here's the price action. I've no idea what's just happened. 42.19 on the S&P. We advance a little more than 0.1% on the S&P 500. Yields unchanged on a 10-year, 148.86. Just remarkable to see 135 at one point yesterday. Where did that come from? Then a huge unwind of that move as well.
It came before the Fed people talked.
Euro dollar 118.95.
They spoke.
And one of those
your
Fed
interview,
people,
John, your interview with John Williams is going to move the market.
A Fed person.
President Williams coming up at 9:30 Eastern. Mike McKee happened to lead that interview. Really looking forward to catching up with the New York Fed president a little bit later on Bloomberg. Live on TV and radio for our audience worldwide. Pushing 42.20 on the S&P 500. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. The U.S. says 150 million Americans have been fully vaccinated against COVID-19. That's more than 45% of the population, but cases are rising in several poorly vaccinated states, with more young people being admitted to hospitals. The highly contagious Delta variant, first identified in India, has been spreading in the south. And India gave out more than 8.6 million vaccine doses in the last 24 hours. That's a daily record for the nation. New cases in the hard-hit country have dropped to the lowest level since March. However, less than 5% of the country's population is fully vaccinated. Some experts are warning that a third wave as the economy reopens from lockdowns. And coronavirus infections surged to a record in South Africa's industrial hub, prompting warnings about hospital capacity and calls for tighter restrictions. 1 in 4 South Africans live in the province, where Johannesburg, the country's biggest city, and Pretoria, the capital, are located. ExxonMobil is said to be preparing to cut some jobs at its U.S. offices. Bloomberg's learned an evaluation system will be used to identify low performers and to cut 5 to 10% annually for the next 3 to 5 years. Exxon had 72,000 employees globally at the end of last year, 40% of them within the U.S. And Netflix has signed director Steven Spielberg to a multi-year deal to create content. The streaming service secured an agreement with Spielberg's production company, Amblin Partners, in a deal that builds on an existing relationship. The two have teamed up before on last year's The Trial of Chicago 7 and another project that's currently in pre-production. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
It is something where you will quite quickly, I think, run out of spare capacity as that demand recovers back to pre-pandemic levels. So, given the conditions that we were seeing, given how quickly, frankly, we've come from $35 back up to $70, to $75, this is something that you could see in the next maybe 12 to 18 months.
That was Saad Rahim there, the Trafigura chief economist from New York City this morning. Good morning, alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferro. Tuesday morning shaping up as follows as we count you down to the opening bell. 1 hour and 12 minutes away. Your S&P 500, 42.20 there and thereabouts, advancing a little more than 1/10%. The story of the commodity market. WTI crude with a 73 handle. Brent crude had a little look at life north of $75 a barrel this morning, Tom, at 75.30. Right now, 74.58.
It is the way it has gotten there. And of course, this is all about the microeconomics and the underpinning of supply and demand. Someone expert on this and consistent in well-written thought is Francisco Blanch of Bank of America Securities, head of global commodities and derivative research. I want to go right away, Francisco, to what is less talked about, and that is the demand dynamic. What do you envision to be the demand dynamic that gets you to your acclaimed $100 a barrel?
Hey, Tom. Hey, thanks for having me. So 3 things are key here. First, there's a lot of pent-up demand. We've all been locked up in our living rooms, in my case, but really with very little movement, whether it's business or personal. There's a huge amount of pent-up demand that we're already seeing in the U.S. The rest of the world is going to join soon. Europe is maybe a couple months behind, and emerging markets are between 6 and 12 months behind the U.S. They're the big laggards, but we think they're going to come back in a huge way over the next 12 months as vaccines get distributed. Second reason, Tom, is really around what we call the avoidance of mass transit. People are going to be using more private vehicles, avoid subways and buses for an extended period of time. Third reason really is what we call the new work from home, or as we put it, work from car situation. People are going to be working remotely 1 or 2 days a week in the future, and that's going to lead to more driving, not less driving, in our view. Again, we are basing this opinion on estimates pre-pandemic and studies pre-pandemic that suggested that 1 or 2 days of work from home eventually leads to more, not less driving. Okay. Those are the 3 main reasons on the demand side, Tom.
Of course, on the flip side, when it comes to the demand picture, business travel not coming back as quickly, with a lot of companies saying that they are going to return to just small fractions of what they used to do. How much does that factor into your estimates?
Well, so business travel is a big factor for airlines, but let me just give you one data point. In 2019, average travel was roughly 2.3 million passengers per day going through TSA checkpoints. We are back at 2 million, and we still don't have any business travel going on. So clearly, I think the pent-up demand story seems to me is going to overwhelm the business travel story, at least over the course of the next 12 to 18 months.
Yeah.
I'm not claiming this will last forever, but I think there's going to be a huge surge here over the next few quarters.
On the flip side, the supply picture, we have this morning a story about how Russia is arguing potentially for an OPEC plus supply increase, a boost based on this increase in demand. You're starting to hear about shale producers eyeing what it would look like to bring a little bit more production online. How much do you expect that to accelerate? How does that affect the $100 a barrel call?
Right. So it certainly does. My expectation with regards to shale is that we're going to see producers lagging for the most part. Remember, there's 3 elements of this that on the non-OPEC side that are going to hold back supply. Number 1 is the fact that government policies are going to pressure companies to invest less. Right? We are seeing that with International Energy Agency calling for an end to oil and gas investments to meet Paris climate goals. Second reason is we are seeing investors pressuring companies, whether it's for financial reasons to see more cash flows coming back, or for ESG reasons to reduce investment. And the third element really is the judiciary. We now seen with the case of Shell that the judiciary can also get involved and force you legally to reduce your emissions. With regards to OPEC, it's the big risk in our call. Does OPEC discipline hold? My guess it probably will. Remember, we've only averaged $64 a barrel so far this year. The average OPEC budget is at 70. So they want to make up what they lost last year in terms of ground.
Francisco, as we speak, Bitcoin breaks down. Brad, maybe we've got an intraday chart of Bitcoin to help us out here. We've had people on Bloomberg talking up Bitcoin, its stability. Francisco, I want to cut to the chase. A grizzled pro like you, is Bitcoin linked to gold? Is there a compare and contrast, a correlation, a relationship of Bitcoin to gold?
Okay, so let me cut to the chase. You know, I put a pretty negative piece on Bitcoin back in March entitled "Bitcoin's Dirty Little Secrets," where I argued that Bitcoin had serious environmental issues, and obviously there was a big U-turn in Tesla.
China agrees with you,
and China agrees with us too, as well, of course, because they are burning a huge amount of coal to produce those Bitcoin, to mine those Bitcoin. This is my take on Bitcoin. Bitcoin, it was completely uncorrelated to other asset classes. It became more of a risk asset in the past 12 months. It was highly correlated to equities, to Mexican peso, to copper. And gold is a safe asset. It's typically correlated to 10-year treasuries, to Japanese yen. So to your question, are Bitcoin and gold linked? In a way they are, because one is a risk asset, the other one is a safe asset. So they're very different characteristics. Now, what is going to be the long run story for Bitcoin? I don't know. What I know now is that it's a risk asset and gold's a safe asset. And gold's been a safe asset for a very, very long period of time. So I'm pretty confident gold stays a safe asset. Bitcoin could keep changing, but for now, they're inversely correlated, quite inversely correlated.
Francisco, you're making such a good point, and I want to finish on this. You can have a risk-on asset and a risk-off asset, both in inflationary environments. So you can be risk-on in an inflationary environment, and the likes of Bitcoin does well, and risk-off in an inflationary environment, and the likes of gold should do well. Is that what you're saying, Francisco?
Not quite. I guess not quite what I'm saying. I mean, I'm not sure I see Bitcoin as an inflationary asset.
Okay.
I think Bitcoin, if you look at the correlations to five-year forwards, if you look at correlations to 10-year inflation, if you look at correlations to CPI, there is not much there. I think what Bitcoin is good for is that it's creating a new ecosystem of value transfer. It's creating a new economic organization, based on the stakeholder economy as opposed to the shareholder economy that we have today. And again, Bitcoin is the base of that, built on Ethereum, built on the rest of other coins that are coming behind it. That's what I think is ultimately going to shape up. It's basically communities of people that transfer value using these cryptocurrencies, which is why the IRS is so interested in taxing this, because they realize there is a lot of economic activity, real economic activity, not just criminal gangs. It's also a lot of people that are actually transferring, whether it's music or videos or anything they produce via the digital asset world.
It's a good job I got you to clarify, isn't it? Francisco, thank you, sir. It's good to see you, as always. Francisco Blanch, thank you, sir, from Bank of America. It's day 2 of the Qatar Economic Forum right now, a conversation on the future of post-pandemic air travel with our good friend Guy Johnson and the CEOs from Boeing, Qatar Air and IAG. Bloomberg Terminal subscribers can watch on Live Go from New York City this morning with Bitcoin dropping below 30K for the first time since January. This is Bloomberg. From New York City for our audience worldwide, live on TV and radio, this is Bloomberg Surveillance alongside Tom Keene, Lisa Abramowicz. I'm Jonathan Ferrell. Your equity market 60 minutes away from the opening bell, shaping up as follows. The S&P just short of 42.20 on the S&P 500. We advanced a little more than 0.1%. Yields are basically unchanged, just south of 150 at 149.37, Tom, after a huge roller coaster of a ride over the last several sessions.
Yeah, it's been just that, a roller coaster ride, but I would just watch what happens today. And, John, that will be wrapped around Fed Speak.
We'll be catching up with President Williams alongside Michael McKee at 9:30 Eastern Time. Mike joining us now for a preview of that. Mike McKee, we've had the likes of President Bullard and President Kaplan really set the stage on this. They've made a lot of noise. Mike, what's the pushback going to sound like in 60 minutes?
Well, I think we got a hint of that from John Williams yesterday when he said we're still a long way from making the substantial progress that he thinks is necessary to start changing monetary policy. The question we have for him, of course, is what constitutes substantial progress? You've got Bullard and Kaplan saying that the rapid drop in unemployment and the rise in inflation suggests that maybe we're getting close to that. Does John think we're close to it, or we still are going to be many months away?
Mike, I want to go back 10 years to John Williams putting in the research work at San Francisco on R-starred. And the paper was, have we underestimated the likelihood of severe zero-bound events? Well, 10 years on, we have lived it, Mike McKee. What is he going to say about a theory? And let's be clear, folks, Williams could win a Nobel Prize for this. There's no question about this. But Mike McKee, the path from Newt Vixel to John Maynard Keynes, and I mean seriously, to John Williams, what's he going to say of the validity of R-starred?
Well, R-star, of course, relates to the potential growth of an economy, and his work showed that it moves around. It's not a static number. And so I think he's going to be still defending that, but there are times when you get close to the zero bound, they have said, where it doesn't really come into play. It doesn't move all that much because your interest rates are so low, and that also means your economy is not moving very quickly. So it's something to keep an eye on, is whether or not potential growth rises. Now, the Fed's forecast that they put out last week with the Survey of Economic Projections is that the economy will drop back. It will grow very quickly this year, and then it will drop back to around 1.92% 2 years from now. So R-star doesn't move very much, and we can ask him why.
Yeah, well, there's also why the market seems to be so concerned that R-star could move even lower should the Fed move away from their stimulus too early. And this idea that a lot of people were raising after the market response to the Fed's meeting last week, that inflation expectations over the longer term went lower. How much do you expect him to push back on that?
Well, I think he's not going to push back on the idea of lower inflation expectations, because that would mean the Fed is doing its job. If inflation expectations come down, they have the credibility that people think that they are going to act on inflation if it gets out of control. The question is, does it get out of control? Does it accelerate too fast? And both Kaplan and Bullard and Williams have all made the case that there is this big debate and there's this great uncertainty about what's going to happen. And to give you a good example of the uncertainty, you got Ray Dalio, who founded Bridgewater, saying we're going to have runaway inflation. And you've got Bob Prince, who runs Bridgewater today for Ray Dalio, saying we're not. And that's the same company.
That's what Tom likes to see play out publicly. Mike, looking forward to the conversation, and thanks for all the hard work you put into these interviews. We'll be carrying that interview on TV and radio, 9:30 Eastern time. So TK in about 56 minutes.
Yeah, it's an incredibly important interview. I can't say enough about this, folks. We partition economics. John Williams out of Berkeley, and then he went across the pond after LSE to Stanford. John Farrell, John Williams is truly one of our original academic theorists. The only one I can think of in the modern sense in Fed is Clarida.
And part of the core of the Federal Reserve. You mentioned Vice Chair Clarida along with Chair Powell, the three of them there, Tom. You're likely to hear some pushback from what we've heard from Bullard and Kaplan over the last week.
Major pushback, and the huge mystery here, and this goes back again to another paper on the unknown. We get a briefing now on this to prepare for our conversation with, Professor Williams, Dr. Williams, with Neil Shearing of Capital Economics. Neil Shearing, from where you visit in the wonderful global economics of Capital Economics, do you believe in R-star? Do you believe it's a countable and useful number?
Well, I believe in R-star, but I think you hit the nub of the issue there. Is it a useful number? It's like all these concepts we have in economics. Output gaps is another one. They're useful theoretical concepts. Measuring them in practice is difficult. Measuring them in real time, anticipating shifts in them in real time is fraught with difficulty, and I think can lead to policy mistakes. So it's I think it falls into that bucket of analytical tools, a bit like output gaps. Like I say, useful to have, useful framework for thinking, but we have to be very careful when we then translate that into what it means for policy.
Does Capital Economics suggest that the Fed is making a policy error?
Well, I think again it comes back to what is the stated aims of policy, and this gets to the heart of the issue. I think with the flexible average inflation target regime is it can be interpreted in different ways by different policymakers, and we've seen that play out in the response to the FOMC meeting and subsequently last week and in subsequent days. It's being interpreted in different ways by different people. Now, if you're asking me, do I think we're going to have double-digit inflation in the US? and that constitutes a policy error? No, I don't. Do I think that core inflation is going to be allowed to run sustainably higher than 2% over the next 3 or 4 or 5 years? Yes, I think it probably will. And do I think that's a mistake? The real question is, does it then accelerate beyond that, I think? And once the inflation genie's out of the bottle, do they struggle to kind of keep it at 2, 3, 4%, or does it go beyond that? Don't forget that in the 50s and 60s, we had those types of rates for inflation, 2, 3, 4%. That was instrumental in getting government debt ratios back down after the Second World War. It wouldn't surprise me if that's what we're trying to head towards today.
Neil, there's higher than expected inflation, and then there's a question of growth. Do you think that we've reached peak growth already, or do you think that we will see it in the months to come?
We've reached peak growth, but that's really only because the supersized rates of growth, turbocharged rates of growth that we had in the first quarter of this year, back end of last year, is all about the burst of activity coming back on after economies reopen. So really that's just unwinding the falls in output that we saw during the pandemic. So the US economy now, on our measures, is pretty much back to the same size it was before the pandemic struck. So it's no surprise that growth is really slowing, I don't think. What to my mind is interesting is what's the trend rate of growth in the economy? Has there been permanent damage to the supply potential of the US economy and other economies as a result of the pandemic? And then from there, of course, it's an easy jump to how loose should policy be allowed to run, and when does that start to generate inflation pressures? Now, the bet in the market is that there has been some permanent damage to supply potential. That's what most central banks are saying. I think that actually there hasn't been permanent damage to supply potential. You can probably allow economies to run hotter for longer before we start to generate meaningful inflation pressure.
What data points are you looking for, Neil, for some sort of compass for how to project the future here?
Well, I think there's two things I'm paying really, really close attention to. Labour markets is the obvious one when it comes to inflation. We're seeing huge friction, I think, in labour markets across the globe, particularly in the US. It was never likely that the 25 million people that lost their jobs during the pandemic in the US were going to get put back to work quickly and easily. And we're starting to see shortages appear. The question is, how quickly do those work through? So I'm looking at things like the MFIB, jobs hard to fill indices. They're I think, critical to shedding some light on how transitory or not these labour market problems are. On the other side of the world, pay close attention to what's happening to Asian exports, because they're levelling off in levels terms in recent months. There's some signs that export orders are starting to level off too. And that might be the first indication that this huge transition that we had in spending in the developed world away from services and towards goods during the pandemic is starting to unwind, and maybe that's going to start to weigh on economies in the emerging world, particularly in Asia. So they're the two things I would pay close attention to over the coming months.
Neil, I've been away from the microphone for the last couple of weeks. Tom says I'm a little bit rusty. In about 50 minutes, we'll catch up with President Williams. Can you give us a question? What's the number one for you at the moment?
Well, I think I'd be looking for some clarity really around the flexible average inflation target. How are they interpreting that? And it's all very well us saying that we're allowing inflation to run a bit hot. Exactly what does that mean? That's what I'm looking for.
We need some quantitative guidance, don't we? Neil, thank you. Neil Shearing, Capital Economics Group Chief Economist. We haven't seen that progress that some of these officials want to see, Tom. We're just not clear on how much progress they want to see.
There's massive unknown. Of course, unknown and expectations is one of the great parts of John Williams' research. And Johnny, unknown right now. Somebody yesterday had a wonderful research note where they talked about the uncertainty right now is just off the chart. Yes, it is.
One key variable, I think, Lisa, and I think a lot of people agree as well, is the participation rate in the labour market. What happens with it over the next 12, 18 months?
And even beyond, right? I mean, we've seen a declining participation rate over the past few decades. How much does this have to do with the automation and the technological shifts? How much does this have to do with the skills or lack thereof that certain people have to fill the roles? This is a huge question, and it's got some serious policy questions around it as well. I mean, I'm talking about UBI, the idea of some sort of supplemental income on a regular basis.
That's what's coming up, a conversation on the open with the Federal Reserve Bank of New York President John Williams alongside myself and Michael McKee, taking place on Bloomberg Radio and on Bloomberg TV. That's taking place in about 50 minutes' time, Tom, after we've heard so much from Presidents Bullard, Presidents Kaplan. The core of the Fed begins to push back. with a little bit more might.
Well, I'll agree it could be market moving, but same can be said for Czech English football. I mean, you're going to move, John, right on from your 9 o'clock hour to 3 p.m. this afternoon. Can England, leave the Euro thingy if they lose?
No. They go through to the next round regardless, I think, now.
Oh, okay.
Tom, this is about top in the group and who you play in the knockout round. Did we do a bracket? Did a bracket happen?
No, I didn't.
No, there were no brackets.
John,
that's what we're calling
here.
it.
John, if you're not here, we have no interest. 0-0, Scotland, England. Ties.
Thank you, Tom. Do we still have that Simpsons
we
opening
do.
skit?
I did it out on Twitter when you were...
We should play that.
John, it's good to have you back.
Hey, TK, it's great to be back with you.
Maybe your data check tomorrow will be better.
Thank you. I'll practice tonight.
Thank you.
That was the most authentic moment of the last 3 hours.
He sits in a bar with chamomile tea and practices.
Tom Keene, Lisa Abramowicz, Jonathan Ferrell, live on TV and radio from New York City. This is Bloomberg Surveillance.
With the First Word News, I'm Rishka Gupta. Google is facing a European Union investigation into its advertising technology. The European Commission says its case will assess whether the search giant breaches competition rules by favoring its own online display advertising technologies over rivals, according to a statement today. The probe will also look into whether Google blocks rivals' access to user data. Blackstone Group has agreed to buy a company that buys and rents single-family homes in a $6 billion deal. It's a sign Wall Street believes the U.S. housing market is going to stay hot. The investment firm is said to have reached a deal to acquire Home Partners of America. That company owns more than 17,000 houses, which it rents out and offers its tenants the chance to eventually buy. And Gamestop climbed in pre-market trading today after announcing that it completed an at-the-market offering program by selling 5 million shares for a total of more than $1.1 billion. Shares of the video game retailer surged as much as 11% in pre-market trading after the announcement. The company says it will use net proceeds from the offering for investing in growth initiatives and maintaining a strong balance sheet. NFL player Carl Nassib has announced that he's gay, making him the first active player in the league to come out. The Las Vegas Raiders player revealed the news on Instagram, saying he's pretty private but hopes that his coming out would mean other people would not have to make similar videos in the future. He added he's donating $100,000 to a non-profit that works to prevent suicide amongst LGBTQ plus youth. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
People from all around the world should be able to travel to one another's countries. And I think that is the way it will develop, but we've got to get a little less politics involved and a little more science, because these vaccines are in fact effective.
The gentleman from Boeing, David Calhoun, speaking there, their chief executive officer. This, of course, at the Qatar Economic Forum, powered by Bloomberg. We're thrilled that he could join us for those important comments. Right now, Lisa Abramowicz and I are going to have a 4-hour conversation with Barry Ritholtz, because that's how much there is to talk about. But Barry, to be honest, I got to rip it up, and I've got to look at Bitcoin, trying to find a 28,000 level. Barry, I took Bitcoin to logs, and one of my support levels is 7,000, down way below where we are right now. How do you explain to your clientele what support is on any given asset?
Well, it depends on the asset class. So when we're talking about bonds, it's yield relative to inflation and national growth rate. When we talk about equities, it's earnings and growth rate and a whole number of other factors. When we look at Bitcoin, and arguably you could make the argument, the same claim about any currency, it's just the collective delusion of what everybody agrees a currency is worth. And when I say delusion, I'm not dissing fiat currency or crypto. The fact that we can exchange little green pieces of paper with long dead presidents on it and get goods and services in exchange for it, can the crypto folks argue is also a collective delusion, albeit one backed by a standing military and a very, very robust legal enforcement mechanism to collect taxes. Crypto doesn't have that second part. And so while it certainly is a consensus sentiment trade and a momentum trade and a narrative trade, it lacks some of the teeth that traditional fiat currency has.
And this goes, Barry, to your writing, which is about how narratives have taken over the market. What's the Bitcoin narrative to Barry Ritholtz?
Well, the Bitcoin narrative is the great financial crisis led to a massive group of ill-advised government interventions. Since then, central banks around the world have been printing. I love the meme, printer goes brr. And therefore, all of these fiat currencies are going to become worthless. Your choice is either buy crypto and drive Lambos, or hold on to your fiat currency, which will soon be worthless. And P.S., as a public service, I like to tell people, send me all of your worthless U.S. fiat currency, and I promise to dispose of it properly.
Well, Barry, there's another narrative that actually has gained some steam among the hedge fund industry, among institutional investors, the likes of Troy Gajewski of Skybridge coming on and saying that it's actually the determining factor in your outperformance because it's a macro bet on the basically worthlessness, increasing worthlessness of fiat currency, but also the money printing that we've seen, the money printer go burr. And there's a question of whether there are forced sales or whether that narrative gets reversed when you start seeing Bitcoin have its worst two-day plunge since March of 2020. And when you start looking at levels that we saw 50% below the highs this year.
Right. So in the battle between China and Elon Musk, China is winning, at least when it comes to crypto. But, here's the way I really think about Bitcoin and the rest of the blockchain universe, which is something complete. The technology is very different than the tradable asset. Bitcoin was about $1 trillion and change, smaller than Microsoft, Apple, bigger than Home Depot or Chase. And so it captures an immense amount of mind share. But if you think of this as a really successful company who's had a great run up in stock price, puts it in a little different context. I think there's been the fear of missing out on the next new thing. A lot of people plowed into this maybe a little late, and watching anything get cut in half is always painful if you're long and wrong, especially if you were anywhere near the top of that. But I don't think we would talk about Bitcoin the same way if we really thought of this as like an individual company. Now, lots of folks are forecasting Tesla going to 5,000 and Bitcoin going to 100,000. And there are all these crazy forecasts. And for the most part, those wild outliers don't work well for investors. But keep in mind, this has yet to come up with a solid use function. Hold aside, kidnapping and ransomware and other illegalities. We're still waiting for the use case for this. There are lots of signs that blockchain is going to do some really interesting things, but it has yet, after 15 years, it has yet to really change the nature of our financial economy.
Barry, we're out of time. Thanks. Wonderful to catch you here with Bitcoin 30,000 now to 29 level. We're looking for 28,000. We're not there yet as well. Mr. Ritholtz writing for Bloomberg Opinion. Lisa, I guess we could sit on Bitcoin, but let's get back to the rest of the market right now. And I'm sorry, it is about Fed speak, and this interview with Dr. Williams of the New York Fed is a big deal.
Right now, you're seeing a reflation of the reflation trade, at least when you take a look on the margins at bond markets. Interesting to see that equities are kind of range bound here. But yes, very much looking to see what Fed Chair Jay Powell tries to walk back from the more hawkish tone that the central bank gave off last week. Again, Tom, they shouldn't be that unhappy with the reaction. It was not some sort of taper tantrum. There wasn't a disproportionate response. But there are some concerns that are sort of baked into the market response, and that is a decline in longer-term inflation expectations.
You bring up a really important point. And, folks, the way I gauge the pendulum of taper is to look at the VIX. And, I know it's hackneyed, but the fact is I look at the VIX, and it got out 2021 level. I haven't even looked. I don't have time to look now, Lisa, because I'm watching BitDog. But the bottom line is the VIX didn't get out to 30.
Yeah.
It didn't get out to 42, and that's your tantrum.
Yeah, right now it's 1769, just to give you a sense of where we are. But you saw the exact same kind of muted action in the implied volatility in Treasury yields, the MOVE index of Bank of America Merrill Lynch. Also not showing a huge spike up in implied volatility going forward. This should be a positive for the Fed. This should give them confidence that they can start to signal possibly tapering or raising rates, save for the inflation expectations. And that, I think, is really the sort of the needle they have to thread right now.
Well, this is a headline that we've got to bring to you because this will be the talk of global Wall Street, and we like to be the talk of global Wall Street. A small German bank has a minority investor with a great interest because their minority investment is a great investment. That would be from Qatar. And I'm not sure this is at the Bloomberg Forum, but I would say, Lisa, Deutsche Bank's top Qatari holder says time is right for mergers.
Yeah.
I've never seen that headline before.
No, and this sort of speaks to the consolidation among the European banking system that people have been calling for.
The initial catalyst. The news flow is actually quite extraordinary.
Yeah, it's picking up.
John Williams with our Michael McKee and our John Farrell. Look for that. That's an important interview. Futures, well, we've gone a little fractionally red. It's an optimistic red on the screen.
Optimistic.
Stay with us. This is Bloomberg.